Hey, good morning, good morning. Welcome to Trade Live with IG. I'm just looking at the date because I thought it was genuinely Friday today.
You did. You came in and said, "Happy Friday, Rich." And I was confused. I thought she was gaslighting me for a second. But we are on Thursday, October the 10th.
Yeah. Robotaxi Day, and for those of you that watch the action, which will take you through because it's going to lead us into a very exciting opening bell. Let's take them through what we're going to be doing first today because it's really exciting.
So 8:45, we've got Tom's takeover. So that is trade expectations with Tom Wolstenholme, and he's going to be putting on his first trade today.
Hey! And then at 9:30, we'll have Pete Ward, one of our best PCMs. He's going to be joining us live to tell us about...
Controversial.
Well, I did see him yesterday. He was very nice to me.
Has he bribed you to say that he's one of the best,
We've cut a deal.
Right. Okay. And interesting, there is a new podcast. Himself, Sarah, and Luke have released a podcast on Apple downloads.
Yes.
And I've had a listen to it. Fantastic, worth listening to. And Pete will be coming on to probably publicise his own thing, I would imagine.
Yeah, he doesn't even need to publicise his, he bribed me nevertheless. But anyway, cut the long story short, it's not just that, but also the fact that today, I think today is a day when you trade trade or sell the rumour.
You've bought the fact.
Sell the rumour.
And on the Tesla thing, right?
Yeah. But I'll tell you about my theory in a bit.
Yeah, we'll need to go through times and everything because I haven't actually looked at this because I don't trade the stock.
It's 2 a.m. So if you're trading from London, it's 2 a.m. our time.
Please tell me you're not going to stay up for that.
I might actually stay up for it.
We're off to the Shakespeare Globe this afternoon, Ange and I.
We are, which is why I've timed it already. After Shakespeare's Globe, I'm going to have an afternoon kit.
Right, okay, and then get back up for Robotaxi.
Yeah. Just because I think it's going to be a circus, right?
Yeah, true. It'll definitely be. I'm sure it'll give us plenty to talk about on tomorrow's show.
Yeah.
We can probably do a whole segment.
Did you see the text I sent you last night saying Musk's latest plan, which is so crazy? So he was saying that those Teslas that are owned by people, if they're not used, people can also rent out their Teslas when they're not using it, so they join the Robotaxi fleet. And
Ange was worried about the state of her car, how it might come back. She worried there would be an improvement.
Can you imagine? Probably would. But can you imagine if it went out and picked up Rich, then picked up Wardy?
Eating my almond croissant from Pret all over your back seat.
Yeah, and Rich does this strange thing I've learnt now, that he eats half of it and then leaves it there for a bit. So can you imagine?
I'm a pleasure delayer.
I want pleasure now.
If I buy a box of biscuits and I put it into the cupboard, I can literally have one biscuit a day.
How about if someone gave you a Ferrari for your birthday but gave it to you 2 weeks early? Would you still wait?
No, for Christmas, I never went searching for my presents around my house.
You
never.
were sick.
Yep.
What's wrong with you?
Because it is an economic theory that you get more pleasure from knowing that you're going to have that thing in the future. So your utility builds up by the day rather than having it straight away. It's an actual theory.
Yeah, and Dale's boy just messaging right now saying, Robotaxi Day! I am staying up for it. I am too. You can, I'm sorry, Dale's boy, just like, he's weird.
So we have the comments live, as you may have guessed. Good morning to Monkey Man, always the first on. So drop us comments on the left-hand side there, well, on the right as you're looking at it, I guess. And keen to hear what you're looking at this morning. Speaking of which, Ange and I are going to go into overnight action.
Hey, welcome back, welcome back. Before we get to overnight action, I want to hear from all of you in the chat whether you're weird like Richie Rich here. Let's go.
It's
for presents.
So Vanilla Sky, Tom Cruise and Penelope Cruz are talking
Possibly
about...
the worst film ever.
I went to the premiere of that. That was my first ever movie premiere in Los Angeles. Got to meet Tom Cruise.
Yeah, but it doesn't change the fact that it's a terrible film.
You have to watch it again. You clearly don't understand what's going on if you don't like Vanilla Sky.
People in the gallery, love or hate Vanilla Sky? Ah, they never even heard of it!
This is me showing my age, I think. So I was standing next to the red carpet, and Tom Cruise was coming along shaking everybody's hand, and he got to me, and instead of shaking his hand, I grabbed him like this, and I said, "You can be my wingman any day."
Whoa.
And I didn't know what was going to, was security going to jump me? And he turned and he went, "No, you can be mine." And that was it. My life was made forever. It's the third coolest celebrity I've met.
Oh,
we are going to be talking celebrities with Pete Ward as well.
Are we?
Who's the most interesting celebrity you've ever met, Ange?
Well, you talking about celebrity, does world leader count?
World leader would definitely tick the box on that one.
Okay, so I'll give you my list.
Okay, well, I tell you what, let's go over the news and we'll save that for when Pete's on, because
Okay.
Pete wants to reveal his biggest.
Okay, great.
Mark Carney has given Rachel Reeves a $59 billion bonus before the budget. In this morning's Times, there is the story that he is happy that changing the fiscal rules to include the nation's assets in the calculations is going to be okay. Right, so he's thrown his weight behind this Labour campaign that started on Wednesday, and this is a big story. And it does make sense, to be honest. It makes sense. Why are the assets not included in the national debt? And they want possible plans to target a rise in public sector net wealth in her budget. Now, this gives Rachel Reeves so much headroom, right? 59 billion sterling to make investments into the nation's assets, long-term projects, and who do we have there? Who's on our mug?
So you asked me about some of my favourite people. I have a very long list of people that I've met. So Mark Carney is one of them. And I am therefore very interested in this story.
Yeah, so former Bank of England putting his weight behind Rachel Reeves, right? So that is that's a big win for her, because if they manage to pull this off, then there will be a difference in the budget, and you'll see a lot more talk about doing private-public combinations, partnerships into building, you know, whether it's extensions to the HS2 or motorways, but the nation's assets obviously being those big infrastructure projects, and also helping us towards the carbon emissions target.
I think it would be massive, because it just, you know, it would just really give the government more breathing room, right?
That's exactly it.
And that's what we need, because right now I'm hearing this mixed mood music about, you know, all the, you know, public school fees. Will it, won't it? Will they move on that? Will they, you know, keep to their promise? There's also the question of, if they don't stick to their guns, and where is this money going to come from, right? So I think it's a fascinating story, just like how I think, you know, the government does need to think about relabeling for the property market, relabeling brown land.
Yeah. Has there been talk of that for this one? I'm not sure.
Yes, there has been talk about this, and also Keir Starmer, before he was elected, promised that there would be this relabeling, because you know, obviously we need to keep our green belt, we need to keep, you know, forests pristine and untouched, and we have to ensure that, you know, wildlife is protected. But there are a heck of a load of places. I mean, you can see them everywhere. Abandoned car parks, you know, places that are disused, or quite frankly, places that may look green, but there was a petrol station there, so then no one wants to touch it because it's got oil in the ground, and that means...
Well, yeah, that could be a disaster.
Yeah.
Speaking of which, we'll come back to vestry.
Oh, yes.
Milady.
That's why I had to stop there, but it was a pawn, it was a punt, and, you know...
I haven't seen anything else in the morning press about this morning. Of course, we're waiting for more information from the management. I'm sure they're running around looking at all the other parts of their business, making sure there is, you know, no other skeletons in the closet, let's say, about the costs. But I haven't seen anything in this morning's press. On the comments, we have some good morning. So Xavier, good morning to you. Good morning, Gavin. Let us know what you think. Is Rachel Reeves been handed a big lifeline there, unlike James cleverly What a shocker. There's been a little bit of game theory gone on in the Tory leadership campaign. The backers of Cleverly thought that he was so far out in front that they would lend some of their votes to Robert Jenrick. And in doing that, they've completely messed up and Cleverly got knocked out.
I know.
So now it's a big runoff between Robert and Kemi. I must say, I saw Kemi on Koonsberg show a week past Sunday. She was fantastic. I've never seen someone shoot down Laura Koonsberg the way that she did. It was really impressive.
I have to say, out of the two, my money's on Kemi too.
It looks like it, and that's certainly the way that Betfair is shifting. So 2-to-1 favourite, 2-to-1 on, 1.55 on Betfair for Kemi to win the contest. And yeah, let us know what you think there. Does that change the Tory party? Does that give them a bit more of a fight, or has Cleverly been not so clever and ruined their chances? What else are we looking at this morning then, Ange? What stock stories do we have?
So obviously the one I'm looking at, and also many of our viewers, because we had messages on it already, is Tesla. What I want to highlight as well for those of you trading Tesla, it is very much a sell the rumor most of the time. I mean, the one thing that Elon Musk is good at is creating noise, and it's
Mr. Monorail, as I call him. If you watch The Simpsons.
Yeah, there's a bit of a circus. Is that why you won't touch it? Is that why you're?
The stock's just, it goes on a random walk. It pays no attention to fundamental valuation. I'm a fundamental investor, therefore, if something doesn't pay attention to them, can't trade it.
Well, I'll be watching to see what it says, just because I wait for the candles, so to see where the bounce goes before quickly taking a position. But my key thing is, I'm not so much watching the robotaxi, I'm watching what else they say about humanoid technology, what else they're saying about robovans, robotrucks, because that is the next generation, that's the next phase,
oh my goodness,
if you like.
Robotruck.
And what's also, yeah, a robotruck. It will work in North America. You know, it won't work in, you know.
Well, that's it. If you build everything like a grid, you know, then these things operate a lot better. I'd love to see a robo-truck trying to get through central London.
Or a robo-truck trying to get through like country lanes, right, with brambles and everything. But, you know, in places like Chicago, everything's a grid, right? So it will work then.
Yeah.
They've got huge roads. I love driving in the States. But the other thing that is interesting about Elon Musk as well is it's all about the technology. Everyone thinks it's about, you know, robotaxi and the humanoid. It's all about the tech and how, you know, his main aim is to actually build out this tech infrastructure. Everything from geofencing to, you know, if you get within a 5-mile radius of Rich's favorite restaurant, it says, Rich has been to Leo's, and it's like, you know, 2 miles that way. So that all is enclosed in his tech plan. The robotaxi, interestingly too, if you're trading it just on that, there are some statistics and some analyst research articles I've seen that says that if it takes off, it could surpass Uber very easily, just because it has that flexi fleet ability. So Uber has a constant fleet, but they rely on freelance drivers, right?
Yeah.
The robotaxi can rely on a huge fleet of untapped vehicles, people who just drive at the weekend, for example, and they can, with just an automated button, get that to join the fleet. So it has the ebb and flow.
I mean, so this has been talked about for years, obviously, right? We're at least 10 years away from that.
Yeah, but it is
all these dreams, and this is my problem with Tesla. It's on 148 times earnings for promises in 10 years' time. I just cannot give him that slack. His vision.
I agree with
Dale's
you.
boy. His vision will drive nobody will drive their own vehicles.
Which is why I go back to my first line: sell the rumor.
Yeah. So, Yeah, good morning. This is the most comments we've had in the chat for a long time. Andrew, welcome back, our gilts expert. Great to have you along with the comments. Keep us up to date what you're seeing in that gilts market. And the effect on the utilities, of course. And Raj, welcome to the show. Welcome to the party. Now, Glaxo, is that going to be having a party this morning? Because the Times reporting that they've reached the 2.2 billion settlement over the Zantac cancer claims. So, yeah, we've got, that's of course this US litigation that's been going on. And it was 80,000 state court cases against Zantac, which is real scary numbers when you think about the cases that we've seen in the past. So yeah, we're keen to watch that one this morning. Definitely one on our sights with, of course, S&P new highs again.
No, unbelievable. Does that mean that numbers are new? Where is it? Yet again, this is not fundamental, no technical analysis at all. So putting that out there, you heard me talk earlier in the week about the Chinese ang pao, which is a red packet or hong pao with money in. And Rich noticed, he's got very good memory for numbers, that there's 5729 at the back of it. And
that was the breakout level. And then the top one,
6179.
So that is Anja's year-end target on the S&P. That's the Nasdaq. Let's get the S&P up there. So
6179.
6179.
And Rich called the 5729 because you know, you put on a trade, I put on a take profit at 5729, and indeed that day it did cross 5729.
It did. So this worries me because I am short calls of the 6,000 level, and yeah. So what are we? 5,800. So what's that? 320 points. Oh, that's gonna hurt. So, you know, 5% upside into the end of the year. Santa rally. It's actually tough to argue against it, isn't it?
It's tough to argue against it.
Yeah, right. So yeah, we'll be looking at index trades with Tom Volstenholme in 8:45 this morning. So we'll be looking at how to structure an upside trade with as low premium cost outlay as possible. So that'll be an interesting one. What else have we got this morning? Let's do of course we had FOMC, so let's go over the FOMC. Officials were divided on whether to cut rates by 0.5 point in September, but there was a substantial majority of participants favoured cutting by 0.5 percentage point. Now, this story's fine, like, you know, the minute's a little bit out of date because of that jobs number that we had, the non-farm number, but at the bottom of the article, there's an analyst that basically disregards today's CPI. He says, oh, well, it's fine, the Fed officials aren't worried about inflation anymore, so therefore the market doesn't have to worry about it, and that was one of the reasons that we saw new highs. Well, okay, just be careful how quickly you're writing it off here, because if we look at the expectations for today, which I'm sure we'll chat about later on, but we've got a core number of 3.2, so no change there, not getting any better than last month's. And we have a headline rate that is getting better, that 2.3. But the headline rate is not good enough. The Federal Reserve, they focus on that core inflation rate. They focus on the PCE, not so much the CPI. But will we see any improvement today in core inflation?
Yeah, I think they're going to stick with the 25. Do you think? I mean, that's, and then we might get a hotter inflation number, but I think they'll stick with the.
Well, it's the 25 or nothing. It's the no change that has been gathering pace recently, hasn't it? It's now up to 15%. So we've gone from a 0% chance to now we were 11, then 12, and each day it's gone up 1%.
Wow.
So what does that take us to? That means we're 50-50 in a month's time.
Yeah. I don't know, 0%. I think that would kill the momentum.
Well, if we see a number higher than expected today, what is that percentage chance tomorrow?
Don't say that,
30?
Rich. I've pegged my theories on.
Well, if you're short Tesla, I'm sure that'll help.
But I've pegged my theories at the moment on slightly hotter than expected inflation.
Yeah.
You know?
Yeah, that's what. So if it's hotter than expected, that percentage will go higher of no rate cut.
I don't want it to go higher. Yeah, I want the momentum to continue for that 25 basis point cut. I'm rooting for all my cousins in the US there with mortgages.
Yeah.
Yeah, I mean, also don't forget what happens with that also does depend on what happens in China.
That's right.
Look
How
at
were
the
our
indices.
overnight moves?
My goodness, the Hong Kong HS50 or Hang Seng up 3%. The China A50 up 3.6%. The Hong Kong Tech Index 2.4%. China 8 shares. I mean, yesterday, if you were awake at night, I mean, this would be a bounce day, people. It was just all round what we saw, like a kickback after the previous session's falls. It is key, though, that you know, we hear what happens on Saturday.
Yeah, it's going to be big, isn't it?
It is going to be big, but what I can't stand at the moment is I have spoken to quite a few people with you know, strong business links, shall we say, to that part of the world. And if you ask 10, 5 will give you positive, 5 will give you negative. It's really hard to call.
Yeah. Yeah, so it's, you know, sometimes best to just sit back and watch then, isn't it, and react on Monday morning, I guess.
So I've taken off all my positions. I've taken off my position yesterday on the even the Crane Shares Internet ETF.
Oh yeah.
Which is quite a broad, you know, spectrum until I get more clarity. I do wish that I came in on these stocks though, because you know those gains are good.
Well, let's have a look at how that's affected commodities. So, base metals, copper, small up, $443 there, and we've got iron ore. If we can get the commods up, please, guys. Iron ore up, just down 20 basis points at 770. So not much move in iron ore. They're pretty quiet. Now, oil, of course, we had the inventories out yesterday, but those were a little bit. How do you say, messed up by the effects of the hurricane. So tricky one to watch there. I'm sure there'll be revisions. But we see WTI $73 and Brent crude at 76. Now, one we were watching yesterday, Ange. Gold Whisperer.
I may be the Gold Whisperer, but I'm still waiting for a breakthrough, right? I'm still waiting for a break there. But yesterday
it's pretty much unchanged, isn't it? Yeah.
Yesterday I said 2610. I said 2610, didn't I? And I said I'm waiting on this figure. And look at the line that I've drawn there for you. It's at 2611. So I want some conviction. I want some conviction either on the downside. And I like the 10-minute chart. I normally look at the 10-minute before I go on to a daily and then go on to the weekly, just to check to make sure that my theories are, you know, aligned.
Yeah.
We're seeing confluence there. And right now, can you see there's strong, there are buyers out there at this 2610 level because it's just preventing it from tipping lower. I mean, if we had strong candles tipping down, then I would go for a bearish move. But it's just meandering near that 2610 level. Can you see it? Try it once, twice, and now 3 times.
Okay. Well, I tell you, let's look later on at putting on an options trade, because today could be big on that CPI move in gold. Now, market's about to open in 6 minutes' time. We'll see you after the break for that opening bell.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. Insights every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into three key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for Charting the Markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. Based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back people. Opening bell here, just 1 minute to go. I think plenty already starting to move. We have loads of broken down grades. Do you want to take us through?
Yeah, let's go. So Air France raised to neutral at auto. Lufthansa raised to neutral at auto. Man Group raised to overweight at Barclays. That's a 270 price target. Page Group raised to buy HSBC. Anglo's cut to neutral at JP Morgan. That one is going to have an effect. Anglo's cut to neutral. AstraZeneca cut to hold at Intron. Fevertree cut to neutral. And Wizz Air cut to neutral. So that is interesting.
Wizz Air up for you. Oh, there we are. So quite a few broker moves there. Also taking a quick look at some of the, we're now at the open, 8 o'clock. Taking a look at GlaxoSmithKline. If you want to
how's that one moving?
GlaxoSmithKline is one of those that we are now watching because Rich is going to punch it up for me.
Yes, it hasn't uncrossed just yet. It might be in
just
volatility.
to remind our viewers, it's to settle for its Zantac liability case for up to a whopping 2.2 billion. That's right, 2.2 billion dollars. I mean, all this feels like
that's a bargain, isn't it?
Yes.
To get 80,000 claims out the door.
I know, but it also makes you wonder. Like we had that talcum powder thing, and yes, and then now we've got Zantac. It does make you wonder what else is going to come out of the closet, right? Euro dollar as well. Another one that I'm watching because euro dollar. Trading near 2-month lows on a firmer dollar ahead of ECB minutes later today. Possibly looking to hold around the 109 handle for euro versus a dollar. It will be one that also perhaps you might want to think, trader friends, if you're risk averse, taking it off before that inflation number as well.
Yeah, let's just look at the opening for stocks. So Smith & Nephew up 1, Reckitt's up 1, we've got Burberry up 1. So that's your big FTSE movers. And then on the European side, do we have any big moves? Air France up on that upgrade. So Air France is a winner it's the second big upgrade in Air France in 2 weeks. So that's from Odo. Lifty's following up 1.2. What have we got on the downside, Ange?
Just taking a look at Germany 40. On the downside there, Infineon is down more than 1% there. I think Infineon earlier had some action as well, adding that stock to my workspace. Infineon Technologies releasing some news on Article 40, but I don't think it's that actually. I think it's something else. Have you seen anything that's pushing Infineon down?
No. Let's see. Producer Fred was.
Thanks,
price target
Fred.
cut
Price
by Citigroup.
targets cut by Citigroup. So that's Infineon. Also taking a look at Deutsche Telekom, if you want to put that up. Deutsche Telekom on Rich's chart as he's getting it up. Deutsche Telekom had a bit of news earlier today announcing a share buyback of up to 2 billion euros. So that's quite a big tranche. Look at that move there. Deutsche Telekom announcing a share buyback of up to 2 billion. So that was one I was watching this morning. Along with GlaxoSmithKline. Let's take a look at France as well to see what's going on there. France 40.
So just on Glaxo, it is still not uncrossed. That means that Glaxo is in a volatility auction, which means that it tried to uncross higher or lower by 5%. So big move coming on Glaxo. We're just waiting for that volatility auction to uncross.
Producer Fred's going to keep an eye on it.
Let's see if we've yet nothing on our early indications from the trading desk, unfortunately.
Taking a look at France, Credit Agricole is up 0.5%. NG is up by the same amount. Sanofi, interestingly, despite GSK's news, up 1/3 of a percent. BNP Paribas also on the winners list there. In terms of the losers board, ST Microelectronics down 1.3%. Capgemini up 1% as well. And Kering is down 8%. That's interesting. Ka-ching. That's interesting, given that we saw a bounce back on all the Asia, China, Hong Kong indices.
That's right. Yeah, it feels like we've had that separation at last. That UK stocks are kind of trading with the FTSE rather than with the CSI 300. So yeah, Rio's unchanged. What other miners do we have? Not really too much going on the oil side. Shell unchanged. It's relatively quiet, and Glencore down 10 basis points. So really nothing going on there. Just waiting for, we should get Glaxo. It's uncrossed. And it's higher. What a response from Glaxo.
Yeah.
£15.40 it is trading. That's up 6%, everybody. So Glaxo, the biggest news story of the morning. That is, let's see when it was last trading at that level.
As you said, it's got off lightly. It's got off lightly.
And we're back to when we were trading on the 20th of September. So this one has really been in the doghouse for a while now. You see it's dropped back from the £18 level in May. I remember when these stories first hit the headlines. So you're getting a really strong response there in Glaxo. Let's see if it kicks on from up 6%.
I've just put a trade on a Glaxo, a cheeky trade. Also taking a look at Deutsche Telekom, because Deutsche Telekom is also moving because of that buyback. It is showing some signs of exhaustion now, because that's a 2-minute chart. Can you see it's slightly turning now? Looking at the 10-minute as well for you. It was higher because of that share buyback. I believe it's 2.2 billion, but it is now starting to turn. So those of you trading that, be aware that it is about to turn, or is turning as we speak. Right, what a morning. My
interesting morning. SSE, just anybody that's been following my venture into SSE, building a position there around the 1822 level. Not too much going on, very dull, of course. It's been trading around gilts, it's been trading around on a downgrade from Jefferies to neutral, and of course that Yorkshire Dogger wind farm being delayed. So that's one not too much to talk about this morning. Let's see how those gilts are doing as well, shall we?
Yeah, I feel like you talk about that stock just so you can say Dogger.
The Yorkshire Doggers are in trouble from being delayed. Right, now that, of course, the gilts, that does sort of point towards concerns around the Labour budget, of course, and long gilt trading higher. Let's see where, look at that. That is, as it says in the Times this morning, the international investors are concerned what Rachel Reeves is going to come out with in the budget. A reminder, as the gilt price goes down, that means the yields are going higher. There's also a stat in the Times this morning that the gap between the UK 10-year and German Bunds is at its widest in a long time. So just have a look at that. CNBC bonds is where I find all my rates data. So we've got, UK 10-year at 4.2 and the German Bund at 2.27. So look at that. We are in for a 2% spread between Bunds and gilts. That is kind of scary.
Nice. I like a spread if you're if you're trying to figure out what's happening with two economies. It's a good indicator, right? But also the fact that remember in the good old days when we didn't have all this like super fast digital trading, you could look for really good arbitrage trades.
There's very few arbitrage left with the way that the AI is.
Spreads, people.
God, yeah, it used to be some free money out there, wasn't there?
Yeah. So a quick reminder, as we're watching the open as well, just to keep an eye out for the inflation number. I'm taking a look at euro versus the dollar. Have you done any setups before the inflation number?
We'll chat about it more when Pete Ward comes on, because they were focused on Euro GBP yesterday, and they were talking about the difference between trading cable with regards to the budget and Euro GBP. So it was quite an interesting discussion in their podcast. But I must admit, that story in the Financial Times this morning around Mark Carney giving the thumbs up, that's the former head of the Bank of England, giving the thumbs up to Rachel Reeves for that extra 59 billion, that has given me a bit more confidence around sterling.
Cool.
I was that sterling bear, but if they get away with that, if they pull that rabbit out of the hat, that is a real bonus.
Is there a time frame for it? Do we know when it might be confirmed?
I think it has to go through Parliament, I would imagine. Something that big must have to go through Parliament.
Okay, Rich, I'm gonna, as you're talking, I'm gonna put a trade through on GlaxoSmithKline because it's just done a double touch there. And I'm seeing some nice ATRs showing me downward momentum. I'm going to just get rid of that for now, but I'm going to sell, and I'm going to perhaps put my limit around there.
What is there?
152, let's call it 1529 just for now.
£15.29 is your take profit.
Yep, 1529, and then also going over to oil. I know there's a lot happening in the oil space, but I like trading oil and I like WTI. Just taking a look at that because I am very keen to see this fall below the 7307 level. If we do fall below 7307, then I'm going to short oil. So I'm going to write that figure down, because this is the same thing, trader friends, as understanding that price action is not just price. These are people. These are people out there who are buyers and sellers. So what I'm looking for is where the sellers are and where the buyers are, and in language, you know, that is used in City, you see resistance, support, but it's the same thing. Really, it's the same thing. So I'm looking for a breakthrough of that 7307 level, because I have a bearish feeling about crude. What's your call on crude?
It's just so tricky just now, isn't it? If you've got to take that hurricane into consideration, and then you've got to take OPEC into consideration, and the yeah, exactly. It's yeah.
There's a lot happening out there, right? I think we have, how many minutes or seconds have we got left till the next 7?
So we've had a question on the comments about AI index, and there is an IG AI index. And correct me if I'm wrong, but I think it is this one. If you see on the screen, then this is IG's own AI index, which you can see we've got a breakout going on there. Let's look at it over the longer term. Yeah, that is that. So that's what we're talking about when we say an AI breakout. It's about 3 months now. So we'll get Pete to run us through the constituents, the weightings, etc. But that, I would imagine you'd like that on a chart, do you, Ange?
That's a nice breakout. Can you go further back?
I'm not sure if there's more data, because it was only constructed. Yeah, it was only constructed a few months ago. So therefore, we're stuck to the start of July, unfortunately. But yeah, so that's just on the comments there. We had some questions around.
That's a healthy breakout. That's a healthy breakout. Good one on you, Wardy. That's an interesting one. I might look to trade that one later on. What's a technical analyst's favorite pop song of all time?
Say that again, sorry. What's the technical analyst's
favorite pop song of all time?
Go on. I'm thinking of a Queen. Freddie Mercury.
It's like changing words, but breakout and touch me. Depeche Mode's.
Depeche Mode, of course. Yeah.
Breakout and touch me.
Perfect.
But that is a healthy breakout, people. So what you don't want is for it to, like, you know, just slightly break out just above the line, just poke its head, or, you know, poke its feet below. You don't want that. You want a healthy breakout with conviction. And that on the daily chart shows me a healthy breakout.
Nice.
Yeah. So let's just have a look at the indices, shall we, to see how we are doing. We are 15 minutes in. And for those of you that have just joined the show, welcome to the show. US Tech 100 and Wall Street just slightly lower there after those minutes. But the FTSE up 0.33%. Germany 40. Otherwise, the DAX is down slightly. You see, most days, this is why I like the FTSE and Germany 40 as a pair, because when one is up, the other one tends to be lower. US 500 there, I have to say it's looking a bit flat at the moment. This is all coming after that bounce back that we saw across China.
Okay, going over to the FTSE, so let's update you on those moves. Seen Vodafone having a nice move this morning, 75 basis points. Glaxo holding the 1540 level. That's interesting. That's seems like there's definitely a buyer there around the 40 mark. Barclays up 1.3, Centric up 1.2. What about the losers? We got WPP down 2%, Anglo's down 1%. And then our domestic retail names, Kingfisher and Tesco's, down 1% as well.
Why is Kingfisher down 1%? Do we know?
Now let's see. I actually haven't looked at that one for a while, so let's have a look at if it maybe trading around.
Well, it's just interesting because you know, the I guess Taylor Wimpey is down -3%.
All right.
But Barrett, Bellway, and Travis Perkins are up, so that's interesting. What's happened?
It's Thursday. This is where, remember, this is going back to the trading desk, of course. We'd always have the question, why is a stock down
is it
1%,
dividend?
2%? It's dividend Thursday.
I knew something was weird about it because it's not following the herd.
Exactly. Yeah, you're exactly right. So Kingfisher is 3.8 pence dividend. Tesco 4.25 pennies. Taylor Wimpey 4.8 pence. WPP 15 pennies. So therefore, we almost missed the dividends. Go, criminal. Ex-dividend just in your 250s. Let's see if there's anything. Not really any big ones. The Merchants Trust, Supermarket Income. But yeah, there's your, remember, Thursdays always in the UK is ex-dividend day. So if you get a funky P&L, IG are better than Credit Suisse at adjusting for dividends.
Really?
I used to have to phone through at Credit Suisse and go, I'm down 200 grand on my P&L. My boss has given me shit.
Yeah.
How have you not managed to know that this was a dividend coming? Sorry, we'll get that sorted. 2 hours later, I got my 200 grand back.
Wow.
But IG never had a problem, really impressed. There's another large platform in the UK, which is more about SIPs and ISAs, and they completely forgot to do a stock split for me in the US, in Deckers. So yeah, if, you know, I won't mention their name, but do you remember that old rugby stadium in Ireland, Lansdowne Road? Yeah, it was a hard graves next to Lansdowne Road. Yeah, that was completely forgot to do my stock split, and that took a phone call as well.
And also just a call out to our PCMs out there, because I do sit with them at least once a week, and they do get, probably including Rich as well in the early days, people calling in, and then they're very patient at reminding them, don't worry, it's, you know, ex-dividend, it's, you know, it'll be fine. And so they're ever so patient, these PCMs. So call out to Sarah and Wardy and Luke and Tom and the whole PMA gang out there.
See, now you mentioned that Pete Ward was one of the best ones earlier. You've just named 5 that are better. It's just off the cuff, straight away 5. So when you say one of the best, it's like saying, you know, something's one of the stocks in the FTSE 100. I can only get away with it because Pete Ward's on the show later, and I'm sure he's already prepping to get me back.
Also, I did warn him that we were really going to rib him today, really rib him, because boy, have they teased me about my Burberry Ange, but hey, look at how volatile it is, right? So, Saturday, I'm waiting on Saturday, because I think there will be some positive news out. The problem is I can't get more people to tell me that it's positive than negative. So
Right.
it's an even split.
Okay.
Yeah.
Yeah. Very impressed with whoever's playing the drums in the gallery. It sounds like we've got a musician in there.
Just wondering whether the musician, the people in the gallery, can punch up my chart. I'll try and zoom it in for you, but this is one that caught my eye. It's from LSEG, and it's US stocks and Fed policy. I'll try and zoom in as much as I can. US equities rallying this year as the Fed cut rates for the first time since 2020. But look, this is why I like, it shows you how, the COVID pandemic affected this line here. And then the Fed started its rate hiking cycle over there, the blue line. And then the Fed cut its rates by 50 basis points. So take a look at that wild ride there. We have seen quite a move, but it is, in line with the Fed's movement as well. So very well telegraphed. I don't know whether you can see, but at the bottom there's also the Fed funds target rate. And we like looking at the CME one that Rich popped up earlier on, didn't you?
Yeah, so CME, but I love that you can go by months.
Yeah.
So you can go, not just November, but we can look out to January. Remember, we are at 4.75 to 5% now. In January, the highest expectation is that we are 75 basis points lower at 4 to 4.25. And then in March, the highest expectation is now only 51%, that we are another rate cut lower yet again. So, that takes us, a full percent in the next 6 months. Is that too much? Well, CPI today will give us more to go on that.
Are you taking any positions ahead of CPI? Are you going to wait and react?
I've never been so lean on positions. I wish I could say I've never been so lean in life, but that's thankfully they cut us off here, so you can't see my belly over the desk. But yeah, I've got my SSE. I've got a small long on sterling at the moment, and that's in the back of backing changing our measurement of national debt. And
everyone in the chat saying that you need to get more exercise.
Yeah,
I'm just kidding.
No, it is.
I'm just kidding.
In fact, I would include myself in putting that on the chat.
But just a quick reminder as well, don't forget that we have the all brand new podcasts from our PCMs that I'm going to put on the chat as well, so that you can have that on whilst you are trading a little later on in the day. But just a quick reminder, this morning we saw big moves, GSK and Deutsche Telekom as well, after Deutsche Telekom had a bit of news on its, I believe it was a share buyback of up to 2 billion euros. 2 billion euros was the number. And GlaxoSmithKline to settle the liability for its Zantac cases, up to $2.2 billion. And Rich called it right, you said it was...
It's always just the relief of getting that out of the way. You think, right, could it be 5 billion? Could it be 10 billion? I mean, look at Bayer. Bayer has just been a dog for so long because of that problem with the Monsanto that they inherited. So Glaxo looks like that, thankfully, for everybody, of course, because the 80,000 people that will get the money as well.
I have a terrible confession. I think I still have an original Roundup in my garden somewhere.
An original what, sorry?
Like, the Roundups that caused cancer. and I just haven't had the time to go and hunt it down and chuck it out safely.
Right.
Yeah, but you know, it was the old versions.
What's the word called? Asbestos. When it.
No, it was that weed killer thing.
Right.
That they were trying to sort of get off their backs. Remember after Monsanto?
A Roundup, yeah.
Yeah, Roundup. And back in the day, the old version of this weed killer, I mean, they've changed the name now, right? But it used to be called Roundup. And, you know, loads of people would spray it on the gardens, kids would run across, they use it on school fields.
Oh my goodness.
And they've now found that it causes cancer. But I think I have a very old can, or one of those big jerry cans somewhere, you know, at the bottom of my shed somewhere. But I need to go and find it, get rid of it.
Right, so we have some viewer questions that we're going to try and answer our best to. So we're going to go to confirm and send.
Whoa. Welcome back to Confirm and Send, where we try and answer all your questions. Please bear with us. We have quite a lot coming through, but we'll always try and get to them. If not this show, the next show. Yes, no question too difficult.
Let's go. Question number 1. Oh, there you go. Good one for you, Ange.
How do you identify good entry and exit points in swing trading? So this is one that I like talking about because quite often I tell people, don't just jump in. You know, especially if you're a beginner, and actually, you know, even those of you who are not beginners, take a moment to almost pause and stand back and look at what the chart is telling you. Rich probably looks like the person that jumps in straight away. You know, you know, he has a higher risk tolerance than I have. But I'd like to take a look at the chart. And when I look for a good entry and exit point, what I'm looking for are resistance and support levels. So, for example, with Kering, I can see that you know, their buyers are at 23,437 level. I can see that there's another tranche of levels, buyers rather, at around the 23,927 level, but it's dipped below that. So that, to me, at the moment, where the price action is on the 10-minute chart, is a bearish signal, right? Because it's dipped below. I also know that it dipped below back 7th October. And let's just have a look at the daily chart, because I'm looking for confirmation. Don't ever just, I mean, that's my style, your style might be different, but I use both fundamentals and I use technicals as a confirmation tool. I don't use them on their own. I tend to use a blend of both just because, I don't know, I feel more comfortable like that.
Yeah.
So it's just about having the side mirror, the rear view mirror, the, you know, looking out ahead when you're driving, same principle. So this is my daily chart for Kering. And can you see there, I know that this has got a strong downward momentum that's been carrying through since around April 2023. So what does this tell you? As a swing trader, this tells you, you need to ask yourself, are the buyers or the sellers in control? This is a clear seller's chart, right? Watching Rich for some pain, because I know you hold LV, but I don't know whether you hold...
No, LV's long gone. That was unfortunately sold on that first day of the China stimulus, when it was up, 3%.
Probably very wise. Probably very wise, because we've seen so much volatility. Look, so this is a downward trend here, which gives me that first confirmation that I am headed in the right direction. It's all about confluence, people. So then I looked at my 10-minute, and now I'm looking at the daily. Look, it confirms that we are in a bearish trend. It confirms that we did strike out that breakthrough 8th September, number 1. 2nd, 24th September, yet again, we crossed that line. And now we've crossed it against this, then tells me that perhaps if I go bearish on this, then I will create a very tight stop at 22260. That's how I look at, and the reverse obviously for exit points. If this is if moving upwards, I'll try and see where the resistance points are, and if it breaks through there, I try and put my stop or take profit just under that level.
Brilliant.
Rich?
This is great. I feel like I learn something every single day on the show from you on technicals and swing trade.
She's crazier than I thought.
No, not at all. They're crazy into technicals. There you go. But yeah, absolutely brilliant. So, right, shall we go to question 2? I don't think I can get anywhere close to as good as that explanation. So let's go. How should one diversify a long-term investment portfolio? Right, for this one, I have punched up my pension and ISA because you couldn't get more of a long-term investment portfolio than what I'm looking for there. So this is a breakdown of my asset allocation, and this is by an overall look. So 46% of it is in funds, 26% of it's in UK shares, 23% of it's in international shares, and then 4.7% in cash. Right, now, how does this break down? Well, I like to think of a bit of everything, right? Just to take you through the names first of all.
Buffet?
So,
like a tapas?
It's exactly like a tapas, like a full, well, long term. I guess this would be my 7-course, taster menu from the chef. So the number one way to diversify or hedge yourself is, of course, to actually have something that benefits from the market going down, right? So we're at all-time highs. I'm a little bit nervous. So actually, my biggest position, which is 13%, is the S&P inverse daily, right? So that is actually one that benefits from the market going down. Right, so that's my hedge. Then, as you know, I speak about Vodafone a lot. So 9.6% of Vodafone, Scottish and Southern got in the pension as well. So that's just 2 nice defensive dividend-paying UK companies. So I like those because of their defensive nature. Again, I'm slightly worried that we are at all-time highs, and we are. I 10% down is more likely than an extra 10%
you got
up.
Palladium at number 6.
Come on now, be patient.
Woo.
Stop jumping ahead. So then we've got 7.4% in gold. Occidental has been a very poor one. Occidental, of course, have followed Warren Buffett in. It just shows you don't follow anybody. Don't follow me. Don't follow Ange. Don't follow Warren Buffett. Putting those in the same category is a crime. But we see also, as Ange pointed out, palladium. Now, why do we like palladium, Ange?
Because it is a hedge if you're not quite sure whether the EV, like the EV whole promise is going to really pay off for the world.
Exactly.
And I think palladium gives me a good hedge because I think ultimately there are too many stakeholders out there, people. There are the Saudis, the Emiratis, all those oil producers out there and the Americans now as well. Drill, baby, drill.
That's right. But the great thing in this wider portfolio for diversification is that it gives you something that doesn't move in line with stocks.
Exactly.
So I've got gold.
It's an alternative.
It's the alternative, that's right. Precious metal.
Yes.
Palladium, gold. We've got a bit of copper in there. Now, that does have a higher correlation with the S&P 500, but I obviously like that in the longer term for the potential deficit in the copper market. Quanta Services is my AI play. So that's a bit, diversification also means to be in the big fast-moving things. So that is a thought to do with artificial intelligence. Then FTSE 100, Cameco for uranium, bit of cash in there, 4.7%. GSK, very happy with that this morning. You can see why now.
Yay.
Then further diversification, Saudi Arabia, MSCI, AstraZeneca, along with another defensive. Walgreens for my bit of a lottery ticket there, just in case they manage to sell boots and refinance and re-strategize. And then finally, Deckers, it's just a small one there. That's, of course, they own Hoka, the shoes that are outselling Nike, in my opinion, at the moment all the shops that I go into. So that's that's a way to diversify. And Ange has also got a great thing on the IG site.
If you want to read more about this and also follow different methods of diversifying, IG have put together a very handy site for you to look at, which I'll also pop into the chat window, simply outlining how to diversify your portfolio. What I love about this site is if you scroll down to the bottom, it tells you not just how and why to diversify your portfolio. As Rich rightly said, it's like not just having one dish but having a tapas, and you have a few things that help to mean that you don't have all your eggs in one basket. But it also lists out the different ways of diversifying, and at the bottom, if you get right to the bottom, scroll down to the bottom, it gives you a very handy pie chart of how to diversify if you're a conservative trader or a moderate trader or investor, balanced or growth or aggressive. At the moment,
which one are you, Ange?
I'm currently growth, leaning on aggressive, because my view is that I'm not going to be doing that when I am 75, right? If I get there. I'm not sure I'll get to
You'll be reaping the rewards.
I'm not sure I'll be I'm not sure I can get to the end of this week, never mind 75. But so that's why I'm trying to push it slightly, be a bit more sort of optimistic and more growth and more aggressive and in terms of my pension, and then dial it back as I get closer to my grand old age.
Excellent. Right, time for one more before we take a break before Tom's takeover. When should I close my profitable losing options trades? So this is, of course, taking us back to the wonderful Sahil's research that he keeps on, sort of driving into this mentality of if you're putting options on, the sort of best or most efficient or best timing is around 45 days to expiry. However, they then run them for about 24 days, okay, and from 21 days out, so 21 days until that expiry, that's when you should start looking to manage your positions. Now, that can be closing them, right, and it can be taking the profits, but it can also be rolling them to the next month out. So you get to that 21 days to expiry, and then it's time to roll, like your song.
Rolling, rolling, rolling. How many times can you roll? Like, can you roll perpetually?
Well, it depends. Are you doing it because of a big loss that you don't want to crystallize, or are you doing it because you actually believe in the position, right? So that goes back to investor psychology.
Exactly, which is what SR was talking about the other day, and I was very interested in this because I've seen some traders in the past and they get so invested, so emotionally attached that they just continue, if they're making a loss, they still continue sitting on it and adding a position, adding to the position, right? But when you can roll like that, how long can you sit on it?
I mean, I don't like that mentality at all, because you shouldn't be thinking just because I'm losing.
Yeah.
So the perfect answer to it is when should I close my profitable or losing options trades? When you don't believe in them anymore.
Yeah.
When the actual the story has changed, right? So I've got copper because I believe that there's going to be a deficit. If we go into recession, that deficit gets wiped out. If Antofagasta suddenly find a new huge copper production that won't take long to build, obviously it would, but that's the story changes. So, options, although there's the theory with 45 days and 21 days, you're still trading the underlying. You still should be looking at the underlying fundamental news of what you're trading. And I guess that's how often should I roll? Should you roll to defend an options trade? Or should you roll because the story is still the right story? And that's
the trick.
Yeah. Excellent. Right, we have coming up Tom's takeover, which we're going to take a look at one of those options trade. Let's see what he's got in store for us coming up right after the break.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more, without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into three key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for Charting the Markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
No trader gets it right every time, but you can improve your chances by knowing which pitfalls to avoid. Here are 5 of the most common trading mistakes. Number 1, not preparing properly. Many beginners rush in with misguided confidence and are punished for it by the markets. Take the time to learn about the financial markets and trading strategies, and consider practicing with a demo account before using real funds. Number 2, trading without a plan. Failing to stick to a trading plan or trading without one is a recipe for disaster. To avoid this problem, develop a personal trading plan and use this to decide when to enter and exit trades. It's a good idea to keep a trading log. A trading log is a record of your trades and the reasoning behind them, as this can help you adjust your plan over time. Number 3, over-reliance on software. While technical analysis, advanced charting systems, and automated algorithms can all enhance your trading, blindly following a software program is unwise. Remember, these are just tools, not foolproof strategies. Make sure you understand how each system works, so you can make informed decisions about whether or not to trade. Number 4, failing to cut losses. All traders, no matter how skilled, will inevitably enter some losing trades. And while you may convince yourself a market can't keep going against you, one of the most dangerous misconceptions is thinking you can always turn running losses into profit. So, it's critical to decide when you will close losing trades and to remain disciplined in the heat of the moment. Use stop losses to ensure you exit according to plan. Number 5, overexposure. Beginner traders often fall into the trap of overtrading. For example, opening a host of positions in the wake of an early success. or spreading capital too thinly in an attempt to trade a wide variety of assets. But with thousands of markets on offer, you can't take advantage of every opportunity. So, sit back, consider your trading strategy, and only open a new position if it fits with your plan. To learn more, join the IG Academy for free.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into 3 key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for Charting the Markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Welcome back. This is the Tom takeover once again. Hello.
Number 3.
Number 3, I believe. Yeah. How are you?
Yeah, very well. Yeah, it's quite a good morning so far. Small, long Glaxo in the old, my ISA. We've had a nice reaction this morning to some news, so it's up 6%.
Okay.
Yep.
Mine's going less well because we have received a letter.
Oh dear.
Yeah, from one of our viewers.
Oh, bring it right. This might be our first fan mail.
Yeah,
You're not looking like it's fan mail.
Wait till you hear it. I'm not sure you're going to think that it is in fact fan mail.
Is it from your wife?
It's not from my, well,
okay.
Unless she's under an alias. I don't know.
No comment.
But here's what we've got. Dear so-called Tom Takeover.
So-called?
Yeah. I'm
Right.
particularly displeased with the amount of games and silliness you and Richard have undertaken in the last few segments.
Shame.
Yeah, the low point was Richard demonstrating a cheese grater to try and decipher if it was an option strategy.
Fair call.
You are a disgrace. Please can we have some proper educational content for once?
Right, cool. That's
Yours
a
sincerely,
challenge, isn't it?
Mr. Needham. So thank you, Mr. Needham, for the letter.
Thank you, Mr. Needham.
So
Any constructive criticism is always welcome on this show.
he's always welcome. So last time we went through some options trading strategies, didn't we?
Yes, we did.
Our favourite, I think, was the call butterfly.
Yeah, because it's minimises your risk. So that's, get that upside without the risk.
Yes, exactly. So, and we also want you to be able to use the phrase later on today and go home and say, I'm long a butterfly.
Yes.
That's ultimately the aim.
Brilliant.
So what I thought was, we'll take a quick look at the call butterfly, and we'll place it here now live. So we'll place the 4 legs of the trade.
Right.
And we'll so we can make sure we know how to do it.
Have you decided what instrument you're going to do it on?
Yes, I have. I'm thinking.
Loving it.
I'm thinking. Yeah.
Right.
So,
let's get a trade on.
Yeah, my computer's broken, but if you could have a look at the diagram, we can talk through a little bit about how it.
Right. So well, you've sent me long butterfly spread. So if we take a look at that, why don't you walk us through what it is you're thinking of doing?
So it's a bullish strategy. So ultimately, if we go down a bit and look at the chart, we can see.
You like your diagrams.
I like a
better
diagram.
than-
I'm a visual learner. So if we look at a long call butterfly spread there, you can see what we have to do in order to put that trade on, and we can see that our profitability is in the middle of those two calls there, that green spike.
Okay, do you want me to zoom into the call? There we go, because it looks like we've got. There we go. Right. So talk us through what you're doing here with your green C's, I assume, are buying, and your red selling.
Exactly. So it's just calls involved. We want to be buying. We want to be buying an at the money call.
Okay.
Which is the first green one.
And I would imagine this little circle here is probably where the stock is at the moment. So as you say, at the money call.
Exactly right. And then we want, and we're going to want another call, but we're going to sell the call, two of them, in between kind of that range that we're looking at.
Right. So let's put some fantasy numbers on here. Let's say if at the money was 100.
Correct. If at the money was 100, we might want to sell two calls at 105.
Okay.
And then buy a call at 110.
Perfect. So that is a equal-sided butterfly spread.
Exactly right. Exactly right. So that's the setup of the trade. It's bullish. So what we want is we want the value of the stock to go up, and we can see between those two calls where our profit range lies.
Yeah. So what's this green pyramid then?
So that's showing as stock price goes up, what's going to happen to your profitability.
Nice. So you make all the way from 100 plus the premium, I guess here. So that's what your premium costs. Then you make the money all the way up to this point.
That's your max profit, yeah.
Which will be 105.
Correct. And then as the stock price moves up further, your profitability will come.
And you have to give that money away again.
That's exactly right. Does that make sense?
That makes a lot of sense. Excellent.
So,
right.
If we go to the platform, we'll see if we can pull this off. Maybe we can't. I don't know. I've never done it before. But if we look at FTSE, so I happen to know that in terms of expiries, we're looking at kind of somewhere between 50 and 45-day expiry, ideally.
Okay. So where does that take us to?
So we're on 10th of October. So we're probably going to look at November. It sits in the middle of that range, maybe. So we could look at November, or maybe we want to go further. Do we? Should we look at December?
Yeah, I reckon. Yeah, that's probably. How many days between now and December? That's probably 60, isn't it? But the November might be a little bit close on 30. Which the reason that I'm sort of swaying towards December is because then you get more juice in the ones that you're selling.
Okay.
Right. If we're too close, I tell you what. Let's take a look at them both. So let's take a look at NOV, and at the money is currently 8,259.
Yeah.
So what are you thinking level-wise, or would you like to have a look at the chart?
I think if we put the chart up next to it, that'll give us a good idea, I think.
Right. Okay. Let's. So we'll add that to the workspace, and then we're going to get up your FTSE chart, which is here.
You've got a lot going on there, haven't you?
Yeah. That is right. There we go. So there's the FTSE. Is it going to break out like we've seen in America? That is a long-term chart, and you can see where I've drawn the lines. You can ignore those, or you can. Are you a fan of technical analysis?
No, not particularly.
No, not particularly. Okay. So forget those charts. Forget those. That channel is there. We're currently at 8,240. Where would you like to set your,
So we want the first call to be at the money, almost.
Okay, so 8,250 we'll look at. And then, how much do you think it could possibly go up? I.e., where would you want your maximum profit to be?
Where's your cursor there? About 8,006.
Yeah, so
Good
that's,
is that you're looking at there?
let's see if we can go across to the side. So 8,600, you know, would be around here. I guess in percentage terms, you know, if we're talking 10% might be a little bit much. That's up to 9,100, which means that 5% is halfway in between the two, so like 8,700-ish.
Okay.
Would be up 5% from here,
Okay.
which is there on the chart. Shall we see how they line up with the premiums?
Yeah, let's do it.
Okay, right. Let's get this back down and. Okay, now here's our this is your friend for your options trade. So your call at the money is right there. Okay, you see what that's going to cost?
Yeah.
How much are you going to pay for that then?
So we're probably going to want the 8275, aren't we?
8275, so a little bit cheaper. There we go. Right. So 115 you're going to give me for that. So that'd be 115 pounds, please.
There we go, yeah.
So that's a reminder. So that's in we can also say it's in ticks, right? 115 ticks. Mm-hmm. So i.e. The FTSE is, you know, 1% would be 82 points or 82 ticks. So you're paying, what's that, 1.4% roughly for that call. Mm-hmm. Right, so just remember 115 you're paying out. Now, which one are you looking to sell?
So we want to be, so if we're going to the range of 8,700,
Mm-hmm.
we want to be selling halfway between 8275 and 8,700.
Okay, so that's 425 points is the full amount. So that means, what, you're 212, so you're about 8,400 and... Yeah, there's 8,475 or 8,500.
I mean, visually that looks about right, doesn't it? You can see that's about halfway between the two.
Yeah.
And we want to be selling two at that.
Two of those.
Yeah.
So 8,500?
Yeah.
Or 8,475?
475.
You get 6 points more, that's the big question.
Yeah, 8475 let's do.
Okay, so minus 31 again. So now your net spend is 115 minus 62. So 115 minus 62 must be 38 plus 15, 63. Is that right? 63 plus 62, no, 53. 53 is your net spend at the moment, and you've still got to buy you purchase your upper leg.
Yeah, so we want to be buying a call at 8,700.
Right, that's cheap as chips. So there, you're only getting charged 8 for that. So overall, 61 ticks. That's your cost. What's your upside? So you've bought the 8275, and where's your peak? If we go back to the, let's put it onto the chart again. So this is 8275.
Yeah, at the top we've got 8,700. As in, sorry, at the top, I mean at the far end at the other call.
Down here.
That's 8,700.
8,700. And your peak profit in November expiry would be, yeah, did we do 8,475 it was in the end?
Yeah, that's what we went for.
Okay, so that means that your upside is 200 points.
Look at you go.
But you've paid out 63. Or 61, we said, 61. So therefore, your total profit is 139 points.
Yeah.
Your potential profit for paying out the 61.
Yeah.
So we're saying it's about a 2.3 payoff, 2.2 maybe. You know, if you wanted to do 139 divided by 61, I think that's about 2.2.
I said no more live maths tests.
Oh yeah,
I made
we
it quite clear.
So you'd say this butterfly spread is giving you a 2.2 times payoff, right? And the maximum risk will be 61 points,
Yeah.
which is 0.7-ish%. on the FTSE 100. Nice.
Not bad, eh?
The way to make it cheaper, well, let's see if it does make it cheaper. So we would look at December instead of November, right? So see if we can just take it down here, December expiry. So of course it costs you more, but you also receive more. So that 8275, do you want to read me out the numbers?
What are we looking at? So 8275, you're looking at to buy a call 176.
176. Then 8475.
8475 to buy the call, you're looking at 83.
But you'd be.
Oh, sorry, we're selling two, aren't we? We're selling
Yeah.
two at 74.
74. Right, now do you see the difference? Right? So you're 74 plus 74, so it's 148. So your payout at that point is only 28. And that's the difference, is that for the November one, you were having to pay out 53 just to put on the 1x2. Right? This one, you're only paying 28, so there's more juice in that 8,475.
By going on to and doing December or November?
By going December. Because there's more time for it to go up through your strike. But of course, then we've got to pay more for the 8,700, which is 20. So overall, it costs you 48. So your cost in November was 61?
61.
61, and your cost for December is only 48. So you get more bang for your buck.
There we go.
But then you've got more time to...
More time for it to go down, because if it goes down again, we don't, obviously that's bad for this.
That's good, but at least you know your maximum loss.
You know your maximum loss. Yeah.
Whoa. There we go.
Accidental maths test. Didn't even mean to.
Yeah, you've given me here's my typical trade.
Okay.
I promise you, I'll show you some of my trades for back of an envelope. That's us, Tom. Thank you very much once again. Now, ESAR is short Dell. Would you agree with a short Dell position?
I'd definitely be short this particular Dell because it seems to be allergic to this room.
So poor Tom's computer just gave up with about 30 seconds before we came back on screen. And yeah, that's a small heart attack.
Yeah. I'll throw it away after this.
Thanks very much. Join us up after the break. We've got Live for the Trading Floor.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket. Options. a hugely powerful trading tool with a wide variety of uses. An option is a contract that gives you the right, but not the obligation, to trade a financial market at a set price before a set date in the future. You pay a premium for this right. Options can have daily, weekly, or monthly expiry dates. Say you think the FTSE 100 is going to rise in the next week. Instead of buying the FTSE now, you purchase an option to buy it within the next 7 days. This is known as a call option. It gives you the right to buy the index at a set price, called the strike, before the option expires. If the FTSE moves above the strike at any point within the 7 days, you can exercise your option and buy for less than the current market price. If the FTSE drops instead, you can leave your option to expire, losing only your premium. But options aren't just used to buy a market when a market goes up. Put options give you the right to sell a market at the strike instead of buying. This can make them a great tool for hedging. Say you own Apple stock and are worried it's about to fall in price. Instead of selling your stock immediately, you purchase an option to sell it with a strike that's close to the current market price. If Apple stock drops, you can exercise your option to sell, preventing losses by selling above the current level of the market. If Apple stock rises, you can keep it in your portfolio, again, only losing the premium. You can also use options to speculate on price movements without ever intending to buy or sell the underlying market. That's because an option premium will change over time, depending on how likely it is the option will become profitable. If you purchase an option with a low premium, you can sell it on if it becomes worth more as it nears expiry. With IG, you can trade an extensive range of call and put options on shares, indices, forex, and more.
Welcome back, and we are live from the IG Trade Desk, and it's really exciting because we have the one, the only, Pete Ward, otherwise known as Wardy.
Oh, hang on. I'm going to have to move across a bit. There's not enough room in the middle for you there, son.
Does he? Don't take it. Don't take it.
Me and
Pete.
your ego.
Does he call you fat boy?
Oh, I would never do
PH,
such a thing. But with a PH, because he's so cool.
Do you know, prior to this, you were causing him a headache. He didn't know whether he was coming or going. You know, Pete was like Rich was like a terrible date, right?
He was, yeah, he was. He was saying, "Come in the studio, don't come in the studio. We'll do it from the live from the desk." It's a bad date. Wanted to get the check and get out of there.
If I ended up on a date with you, I mean, that is Tinder gone wrong, isn't it?
So you were going to run a quiz, is that right? You were going to run a quiz with Wardy? So what is it? What is this quiz? Is there money to be made? Come on.
So the quiz with well, I'm interested in which celebrity it is that you've met, Mr. Ward. We have.
What celebrity have I met? What's the quiz? Have you guessed who it is, or?
Well, no. Ange's is a world leader, which
she's interviewed many world leaders.
But who is I want to know who your favorite celebrity is.
That I've met?
Yes.
I met Big Bad Rio Ferdinand outside Annabelle's.
Wow.
Claim to fame. As you do.
As you
hobnobbing
do.
around Mayfair.
Did you have a chat?
We did have a chat. Yeah. He was a very, very, very nice guy.
Was he in Annabelle's? Come on, you can tell us.
It was just on the outside bit. And someone that I was with knew him, so...
I'm more worried if you were in Annabelle's. I'm going to have a word with Richard Caring there.
Yeah, that's it. No, it won't be one of my clients, but yeah, no, it's I met Rio there. I met Nigel Mansell, bit of a blast from the past. The Tour of Britain when we sponsored that back in the day.
Yeah, Formula One driver.
The Formula One driver, yeah.
That's really cool.
That's probably about it, really, to be honest.
Right. Well, I'm going to let you guess my favorite. So, guys, can you hit up my screen?
Ooh.
So this is number 1.
Wowzers.
Number 2.
Man himself.
Number 2. If I can get that up. Number 2. That's number 2. So you had your Tom Cruise moment?
Oh, it's my favourite movie, Good Will Hunting.
And Good Will Hunting. Mm-hmm. Okay, and if you take me off the screen for just a bit, because I think the third one.
Are you looking into your?
Yeah, to make sure I don't put a dodgy one up. And this is number 3. So guess which one was number 1. Top celebrity.
Which one's your favourite?
Yeah.
What do you think, Pete?
Bill Gates, Mark Carney, or Matt Damon?
Probably Mark Carney. You look like having the most fun with Mark Carney.
Actually, that picture got me into real trouble because that year,
No one, he said no to anyone speaking to him. Absolutely not.
Right.
Because the housing market was, too hot to handle. We had problems with the UK economy. There was murmuring of Brexit coming along, and he was just like, I'm just not talking to anyone, no one. But I saw him on the street, and I read so much about him, and listened to him speak that I just like, Mark, and ran across and started speaking. There you go. And we had a great conversation outside the hot dog stand in Davos, because he'd just come out and went to a conference that I was attending as well.
Wonderful.
I mean, for God's sake, we're not in the middle of downtown Chicago. We're in Dallas, fair game, right? Fair game.
Yeah.
Yeah.
So of course the next day, everyone called up to say, why is it she had preferential treatment?
She? Oh, that's harsh.
Yeah, so it was harsh. It was So anyway, out of the 3, Morty wasn't right. It's actually Matt Damon. Because he was the only guy, given his stature, with no entourage, and he was exactly.
Is that a lollipop that you're?
No, it was
to give him there, or?
No, he has his own lollipop too, darling.
Right.
Where was that?
His is a bit furry. No, I had the only interview with him. So anyway, it was there, and he had no entourage. We're doing an interview. He won an award for making. He's got a company that makes spigots. For water.
Okay, I think, come on. Right, so my one, get that quickly in. I was on a double date with Prince Harry and a couple of lovely ladies, and we got Pat coming out of the Arts Club. That is my hand right there. That is my hand.
Wow, that I can tell that's your hand, Rich. I can tell that's your hand.
Paparazzi. And then, there he is.
Oh, very good. There he is.
Me and Hazza. And the best bit was Prince Harry with a friend leaves the club by the less than glamorous fire exit. Whoa. So, right, on to bigger and better things. Mr. Ward, what are we seeing on the trade flow this week?
So I guess, all eyes really have been pointing on CPI figures that are coming out today at 1:30. So people positioning ahead of that, whether that's trading cable, whether that's trading gold, indices. I mean, we've seen lots of different sort of bits and pieces, fun and games from overseas, China particularly. Obviously, we had that badly timed note from Goldman's on Monday, and then the big drop. But then overnight, we saw China A50 came up 6.5%. So big move coming back off the lows, overnight there. And then obviously we had the Dow pushing on yesterday. It feels like there's a bit of rally mood music back in the indices. When you thought actually things were potentially going to start to get a bit shaky, it's just snapped straight back. I mean, it just shows how resilient this market is, really. The fact that people are putting on risk, buying stock, buying index ahead of the number, whereas you'd have probably thought it would be kind of flat-ish, see what the number is and go from there, right? So it feels like money's being ploughed into the long side. I mean, I looked at that sentiment report that we put out, which maps the commitment of traders. So those institutional money market funds and they're still very much long Dow, things like that. So yeah, interesting. But yeah, we'll see what happens at 1:30, I guess.
Are we certainly by the dip mood music now? Because we spoke to Ronnie yesterday from the desk, and he was saying that after
he was saying buy the dip, buy China, and then it moved 6.5%. So maybe he's just lucky.
Now, Axel was actually talking about this yesterday. Is that we've obviously had the geopolitical tension. We've had concerns around the hotter than expected jobs number, and the market's tried to come off, and it hasn't. We've gone to new highs again. In your experience, Pete, is that your vast experience of the many years you've been, longer than Ange and I put together, I think, that you've been in this job. Does that mean that the next move's up because it can't go down?
Not necessarily, no. I think it means that there is more room for the upside. I think people always, clients typically are guilty of selling into a rising market, usually way too early, and thinking, because something's hit an all-time high, therefore it must retrace and come back. But, as we've seen, if you look back to October of last year, where we had those sort of lows in the NASDAQ, and then it just set off. And all of a sudden it was trading with a 17 handle, then an 18, then a 19, and people go, I can't possibly anymore. It keeps going, going. So, and then once you've got that momentum build up, you get FOMO from people that aren't invested that then start adding in. And then if you are short, you've got stops in place higher up. And then if the squeeze comes, they obviously get bought back to close the stop, so you get a further pop. So I don't think you can necessarily say that there isn't further room to the upside.
Do you know who's a FOMO trader on their desk? Luke. Luke's a FOMO trader.
Luke Moore?
Yeah. He doesn't like being left out of a party.
And speaking of which, now I hear that you guys might, be a strong buyer of Apple, and that's because they've got an amazing new podcast come out last night. Tell us more.
Shameless plug, but we did our first pilot edition yesterday of Talking Shop, which was Sarah, myself, and Luke who kind of hosted it. We just did a quick sort of 30-minute chit chat about. The main topic yesterday was the upcoming UK budget and what that might mean for certain sectors. But we're thinking we're going to roll out every 2 weeks, but that will be in the Spotify and YouTube section where you can get Beachy and Bright's existing podcast, which is probably a bit more content heavy.
Well, no, you're still macro. I listened to it and I thought it was very good. Definitely worth a listen because Sarah is very funny.
She did the pre-UK budget one, didn't she? Is that the one that? Yeah. So Sarah comes in with all the knowledge, all the lines. Luke's hosting it, and then Pete's there as well. Just showing.
Cheers, Rich.
Pete, as you mentioned the client sentiment, we have quite a few viewers messaging say, where is this client sentiment? Can you please show us? So I've got Wall Street, which is the Dow up. I'm just showing you on the left-hand side, you have the chart button, then you have the news button, then signals, then there you go. That's the client sentiment button that Pete Ward was talking about. So talk us through the sentiment. What is it telling us, our viewers listening?
So that sentiment wheel there is basically showing you the positioning of our client base, and that's account numbers. It's not weighting, so it's not one particularly large client is one way. It is number of accounts, which shows you the pattern of the overall positioning of the majority, I suppose, which I guess is kind of more useful really because it shows patterns, client patterns. Now there's another report which I have. I don't know if can I share my screen or not?
Yes.
So we have a report which comes to us from one of our analysts over in Dubai.
Director Fred saying that it's not. We don't have that tech capability yet, but we will soon have it.
Okay, cool. Well, basically, there is another report which maps together both the IG client sentiments.
I know the one you're talking about, the Monty's.
The Monty's report. Yeah, we send it out on a Monday and a Thursday. But if you want to be added to that, then just contact your client manager and we can add you on.
Brilliant.
But it's a really useful report.
Fantastic. So we will put this out on Trade Live with IG too. Get in touch or email us at ask@ig.com.
And then just on my YouTube, there's the podcast we're talking about, Talking Shop. So what will happen in the UK budget? So that's on IG UK. You can find that. That will also give you the Beecham and Bright podcasts. But Pete, Sarah, and Luke's great work last night talking about the UK budget.
Thanks so much, Wardy. We'll have you back again next week. Have a good one.
No, thanks for having me, guys. Take care. Thanks a lot. Bye-bye.
Cheers.
Right, that was exciting.
And off he goes. And we're back. We've got room again to breathe.
So you heard it here first. Rio was his favourite. Yours was Harry. And
Harry's favourite was me.
Yes, of course. And we've got market measures next.
Right, so today in Market Measures, we are looking at contract duration and P&L swings. So how does your P&L swing depending on where you are trading, how many days to expiry? So when choosing a contract duration, the primary goal is to use portfolio margin effectively and take appropriate risk. Shorter term contracts tend to have volatile P&L swings for the majority of their duration, while longer term contracts require BPR. Remember, that is your like your margin equivalent, right, on the Tasty platform, BPR. While longer term contracts require BPR be tied up for a long period of time without generating significant profit. So what contract duration gives a reasonable number of occurrences but still has manageable P&L swings? Now, Sahil has done one of his wonderful studies, 2005 until present, and he looks at those 16 delta short strangles. So remember, 16 delta being the far out of the money wings, if you like, 16 delta short strangles held to expiration. They've tested 15, 30, 45 and 60 days to expiry contract durations, and then for each contract duration determined the daily P&L volatility, the maximum P&L volatility, right, the real scary number, and the day of maximum number of occurrences per year when trading once per cycle. So let's dig into that study. How does that look? Now, since shorter term contracts have strikes that are much closer to the at the money, they will be much more sensitive to changes in the underlying price and will have more volatile P&L swings initially. Right? So the shorter term ones, those have more volatile P&L swings. We see the great graph there with, let me see if I can just zoom in on that to give you more of a look. So yeah, at the bottom we've got that 60 days to expiry strangle, a lot less standard deviation move there. Now, on the longer term contracts, however, generally you won't experience these large P&L swings, as you can see with that green line on the chart. You don't experience them until much later in their contract duration, and once the underlying price drifts closer to one of the strikes. Right, so that scary point when you actually get close, like S&P trades, Angeline, when it got up to that 57.50 level, which it eventually went through last night. That's when you start to get those drifts. Now, most contracts begin to see a spike in P&L volatility around halfway through their contract duration. But the peak volatility does not usually occur until well after that halfway point. So 30 plus days to expiry contract durations have a longer buffer period, right? You're safer for longer, giving you more time to assess the viability of the trade. Is it one that you're in right? Are you in wrong? You know, you've got a little bit more buffer time.
That's the point where you kind of like rethink your theory, right? And your conviction. Is the story still the same?
That's exactly right. Do you want to take us through the table there, Ange?
So duration 15 days to expiry, maximum P&L volatility $200, day of max 930 DTE, maximum P&L volatility $211, 24 is the number. 45 days to expiry, $224 is the maximum P&L volatility, 36 and 60 DTE, the maximum P&L volatility there, 106. 57 is the figure for the 60 DTE.
It really pushes out, isn't it? I mean, you know, your day of max volatility being, you know, 96% through the trade, you know, that sounds appealing to me. And yeah, on that 15 days to expiry, God, that's only sort of 55% through. So that's a big difference in the time of your max P&L swing, isn't it?
Yeah, I think you're probably more comfortable with risk than I am, Rich, but I would stick to the sweet spot. I'd stick to the not too much, not too...
The Goldilocks.
Yeah, the Goldilocks, you know. I like volatility, but not crazy volatility.
Yeah, very sensible. Right, however, this longer buffer period comes with a trade-off. Interesting. Trade-off is significantly fewer annual occurrences, of course, because there's just less of them, because you've got them on for longer. So you're assuming one trade per cycle. You've got 24 trades, obviously, in the 15, 12 in the 30. That's basically the number of months, right? 8 trades in the 45, which is, remember, that's the peak for the guys putting them on over there in Chicago. And then you've got 6 trades of the 60s. So really, you know, 6 trades a year, you know, you're going to be maybe struggling to make your budget there. Now, we generally aim for a middle ground contract duration of 45 days to expire, which offers a reasonable timescale for profiting and moderate P&L swings. So that payoff, that's where you get the happy medium. And yes, so that's for the first several weeks of the trade.
And generally, the 30 to 60 DTE is an acceptable range for potential contract durations, but anything shorter is fairly risky, and anything longer is not an efficient use of buying power for active traders. Although it does depend on your personal risk tolerance.
Which you nailed in the last slide. That's exactly your point.
Yeah, I did not front run this, by the way. Yeah.
That's right. I keep this to myself. I don't let Ange see these, so that she's learning along with us.
And also, like, you know, as you see from this slide, you know, when I said, yeah, Rich's risk tolerance is probably higher than mine. See, depends on your personal risk tolerance.
Exactly right. And, you know, tying up that you know, that margin, if you like, or the buying power, you know, it's just not efficient if you're only trading 6 times a year.
No, and this is the key to being an active trader, right? So like I time box my trades because I want to release, right, margin, release, so that I can make the next winning trade, hopefully.
Yeah, and you reduce the chance of getting those horrible margin calls. All right, so the key takeaways for this then. Right, and this is what we've really been looking at with these market measures over the past couple of weeks, is when should I trade? How do I look at my buying power reduction, you know, that BPR? How's that calculated? And then looking at P&L swings as well. So takeaways are, when choosing a contract duration, the primary goal is to use portfolio buying power effectively, efficiently. You strike a balance between a suitable number of occurrences, how many trades you can do a year, and the P&L volatility. We generally aim for a middle ground, a Goldilocks contract duration of 45 days to expiry, which offers a reasonable timescale for profiting and a buffer period to rethink the trade if it's not going correctly. That buffer period is several weeks of moderate P&L volatility.
Nice. Thank you, Baby Shark. That was very informative.
Thank you, Baby Shark. Indeed. Now, do you want to explain to everybody why Sahil is called Baby Shark for those viewers that haven't heard it before?
So Baby Shark is a lovely, lovely gentleman. I've spent many hours with Baby Shark talking about, you know, the different slides and, you know, what is most useful for our clients. And, you know, he's just a really wonderful chap. He's called Baby Shark because his dad is a fellow trader, and I believe the surname is from a Sikh-derived sound, which is something similar to shark. And so when he joined, his son joined, which is Sahil, he became known as Baby Shark.
This is brilliant. No matter what age he is, as long as he's with Tasty. And I don't think anybody ever leaves Tasty, do they? It's such a fantastic place to work by the sounds that they're lifers.
All I can say is I must have a terrible nickname, because no one would tell me what my nickname. I'm sure they've given me one.
And did they come? Do you think they came up with one?
I think so, but I think no one dares tell me. This is the thing, 'cause
I don't think we'll play that game on the comments.
Because Frank has a nickname as well.
What was Frank's?
Didn't you know? I was ribbing him about it throughout the show. So I'll give you a hint. He's got such super smooth skin, and he always looks like he's got a, you know, bookworm. He loves his LPs. You know, I rib him a lot about his red hair and SPF, right? But actually, he's quite resilient. He's called Indoor Kid.
Oh no, I haven't heard this.
Because when he first joined, they all thought it was a bit weird and, you know, bookish, and someone that didn't come out. And sport's a big thing in the US, right? I mean, he's into sport, but, you know, everyone called him Indoor Kid.
There we go, indoor kid. And yeah, I did hear you refer to his lack of needing sun lotion.
On that note, just wanted to go through a trade with all of you, which I've just entered, whilst Rich, bless him, was taking you through the 16 Delta and the DTEs there. I said I was waiting on oil to get above 7307, or do something, right?
Yeah.
Do something at 7307. Rightly or wrongly, I'll show you the trade here. I have entered crude, WTI there, and I outlined the figure there of 7307 as close as I can get to it, right? And that is my basically my stop, and I have put in place a long, and I'm looking for 7379.
Yeah, just scalping a little bit off the top there.
Yeah, and we'll see how this goes, but I think it's broken well enough above my 7307 to give me some conviction, and this is not going to be a long trade. I mean, this one is one I often get asked, how often do you just stay on? This is maybe 1-2 sessions, if not sooner. There are some others that are 5 or 15 days. I mean, I have conviction in the buy now, pay later market. So, yeah, you're like, and which I will change, by the way, when we get closer to earnings season. But look at a firm there. It was down 250, but now it's negative 50. But we are still slowly getting back there. I do still think there is there is conviction here that was caused by a person on the board selling shares. I was so cross with this. I think I texted you in anger. And I only found out like the morning of that someone offloaded a huge amount of shares. But I think the closer we get to the Christmas period, the more we will see this turn into a positive number, and perhaps beyond, because boy, do the Americans love shopping, and boy, are they comfortable with debt. And you know, Nike shoes that you can pay in 4 installments, soon to become 10. Your Walmart and your Costco grocery, now when you go to a Walmart or Costco, without checking your credit, it says, would you like to split this into 25? 25, Rich, right? And so I think, you know, these places, outfits like Affirm, Klarna, they may have a bit of weakness, but they're here to stay. And by the way, Klarna in the UK in the first quarter hired about 100. That's right, not 10.
Yeah, there's appetite there for it.
100 lawyers, because they need lawyers to underwrite all this in case you default.
Oh, wow. Oof. Well, a man with no debt at all, I am sure, is Luke Moore. And Luke says, thank you so much and for the shout out on the new pod. So, look, maybe you want to drop into the comments section of the chat, send everybody the link for that podcast. Everybody, well worth a listen to for Sarah's jokes alone and their views there. Yep, Dan Sand says record credit card defaults in the US.
There you go.
Scary
That's
stuff.
That's it.
It really is, yeah.
But this will only fuel the BNPL sector. And if you don't believe me, go Dan Sands to your closest. What is it? You know the names of all these places. I'm not a retail person. Accessorize or no?
Claire's accessories, yeah.
And if you go in, you'll find that there are banners that have been put up since the beginning of this year saying ear piercing here, pay in 4 installments.
Oh dear, for an ear piercing, wow. Debt. That is, the future of capitalism. Insured. Right, so we're going to now take a look at what's coming up next. Later today, of course, the CPI and everything else to look forward to tomorrow with the start of earnings season.
No trader gets it right every time, but you can improve your chances by knowing which pitfalls to avoid. Here are 5 of the most common trading mistakes. Number 1, not preparing properly. Many beginners rush in with misguided confidence and are punished for it by the markets. Take the time to learn about the financial markets and trading strategies, and consider practicing with a demo account before using real funds. Number 2, trading without a plan. Failing to stick to a trading plan, or trading without one, is a recipe for disaster. To avoid this problem, develop a personal trading plan and use this to decide when to enter and exit trades. It's a good idea to keep a trading log. A trading log is a record of your trades and the reasoning behind them, as this can help you adjust your plan over time. Number 3, over-reliance on software. While technical analysis, advanced charting systems, and automated algorithms can all enhance your trading, blindly following a software program is unwise. Remember, these are just tools, not foolproof strategies. Make sure you understand how each system works so you can make informed decisions about whether or not to trade. Number 4, failing to cut losses. All traders, no matter how skilled, will inevitably enter some losing trades. And while you may convince yourself a market can't keep going against you, one of the most dangerous misconceptions is thinking you can always turn running losses into profit. So, it's critical to decide when you will close losing trades and to remain disciplined in the heat of the moment. Use stop losses to ensure you exit according to plan. Number 5, overexposure. Beginner traders often fall into the trap of overtrading. For example, opening a host of positions in the wake of an early success, or spreading capital too thinly in an attempt to trade a wide variety of assets. But with thousands of markets on offer, you can't take advantage of every opportunity. So, sit back, consider your trading strategy, and only open a new position if it fits with your plan. To learn more, join the IG Academy for free.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Hey trader friends, welcome back, and it's what's next, so that you can line up your positions ahead of the game and be ready for when that volume spikes. A big week, we got CPI, but before that, it's the start of earnings season. I love earnings season. You know, Rich and I have to be carted out of here as we're clicking away trying to
Yes.
catch every trade, and it's a good season for scalping if you're trading that style, or also swing traders. It's a really if you have a few favorites, please remember to stick to the rules. I sometimes get so excited I forget the rules, like scalp one thing at a time, don't scalp.
Oh yeah, that is the problem. If you make £100 on something and you actually don't notice that you're down 400 something, it's the war. You just feel like such an idiot.
Or I text Rich and it's like So just to kickstart things, we got US banks, of course, starting the earnings party. We got JP Morgan, Wells Fargo leading the pack, 11th of October. For those of you that want and trade the sector, we've got an excellent written article here on the IG website by Yep Junrong, our market strategist in Singapore. Not only does it give you the times and dates, whether it's before market, I believe they're all before the market, but also the expectations, the EPS and the forward EPS, Rich's favorite. And also the expectation on the analyst front, what to look out for. Credit loss provisions, apparently the key one to watch. What else have we got?
Yeah, those credit loss provisions are so interesting because, you know, you've obviously got an idea of how the IPO market's been. You've got an idea of how earnings will be, but nobody really knows what's going on underneath the surface. And that's where you start to see, as I think it was Dan Sand pointed out in the chat, with credit cards debt at all-time highs, are the likes of JP Morgan starting to see defaults increase? So do they have to make a bigger credit provision? So that is going to be really interesting thing to watch out in those early results in the banking sector.
Maybe we can play a game too, as this is our first earnings season together. Maybe we can choose one stock a day, a day ahead of the earnings, and then you look at the fundamentals. I take a look at technicals without looking at the fundamentals.
Before the results come out.
Yeah, and we'll see if they line up.
What about as soon as okay, right.
Because it's the US ones, right?
Yeah.
Yeah, so, and then we'll test that theory.
Because obviously the fundamentals really come in when you actually see the numbers. So that's it's almost like, you know, I'm trying to think, if there's all debate about in a football match, who's injured, of course, my fantasy football team, you know, who do I put in, that sort of thing. And you've got all the press speculation. You've got the manager saying, oh, he's a you know, he's 50-50, that kind of thing. And it's all hearsay, and that's what the stock market is, right up until the team's announced, the earnings are announced, and then that's the only time you've got facts to go off. And that's why I love the Federal Reserve meetings so much, because after all the rubbish in the press, boom, you've got the actual facts out there.
So maybe we should choose one that is, you know, during our hours, so like a data point, right?
Or let's just stick around and do it, you know, till 11 a.m. We're just afraid that earnings season, we're going to go into proper overtime. He says no worries. Now, talking about facts hitting the screen, let's take a look at this CPI that is expected today. What are you looking for, and what's going to happen if a real funny number comes out? So the core inflation rate, right? That's the real important one. That takes precedence over the headline. So if one of them beats and one of them misses, always look first at the core. So that's coming in expected to be 3.2%. against last month's exactly the same, 3.2% year on year. The month-on-month figure, however, is expected to drop from 0.3% to 0.2%. Then we've got headline. Now that headline rate is going to look really good, because that's meant to drop from 2.5 to 2.3%, right? If that comes in at 2.3 and the core comes in at 3.1, then the Fed have been completely right. They have conquered inflation. That is, you know, the real eye on the ball has to be on employment then. And, you know, if we see that better than expected core, everything's okay. However, have they taken their eye off inflation too early? That's what we're going to learn today. If that core inflation rate rises to 3.2, and the headline inflation rate doesn't change and is stuck at the 2.5% or 0.2% month on month, then we have to just, that confidence of a market new high suddenly begins to erode, and that will not be taken well, in my humble opinion.
See, I think it's still going to be that core figure will be sticky. You know, it will be sticky. And and I was in the States in July, end of July, Chicago, Michigan, and Washington. And boy, is the services sector there. I mean, it was more expensive than going out to eat here after conversion.
Right.
And so I think, you know, it's going to be sticky. That's my humble view. If you want to read up more before you take a position, and I really implore you to do it, because it's a great piece that's been written by Chris Beecham, our Chief Market Analyst here at IG. You can search this up. I'll also put it on our Trade Live with IG page, on the YouTube, where we have the comment section. But it's the title is U.S. inflation data takes center stage as markets digest strong jobs report. And in it, you'll see the expectation, but also the market implications.
Ooh, nice.
Looking ahead.
Excellent. Now, of course, don't forget we've got initial jobless claims as well. Got that initial jobless claims figure. You know, people have been looking at it. It generally doesn't fluctuate by that much, so we're expected 230 from 225, so a small increase. That's another one to keep an eye on, as well as Captain Cook is speaking to us at 2:15. So Fed speaker Cook speaking at 2:15. By which time, Ange, do you know where we'll be?
We will be at Shakespeare's Globe!
We shall. And do you know what we're going to watch? Which is very ironic after some of today's goings-on.
All I know is I'm going with you. Do I need to know any more?
After Tom's poor Dell computer completely malfunctioning, today we're going to see, if we want to get that up on the screen, the comedy of errors. The irony is not lost upon us.
Epitome of my life.
So yeah, we're very excited. But what time does it start? That's the question. Because are we going to be there for the CPI?
Well, we're going to have to charge our phones after this, won't we? By the way, this is we're going to be there with Teach First, IG. We support a very important charity called Teach First, where we bring young students into our offices. And we spend a whole day with them. Can you imagine a whole day with Rich and Ange? And we take them through how to trade, why we trade, you know, and they get to watch us work. Poor them.
And this is the wonderful website of Teach First. So be a leader, be a teacher, join the UK's, I don't know if that is it? Teacher training.
Not sure that's the right one, Rich. Don't listen to him.
Those who can teach. And teach me how to find the right page.
We will have the teachers here too. It'll be 34 students. The last time, some of them jumped on Terence, Director Terence. I was quite afraid for him. I had to fend them off. Yeah, because lots of girls. So that I might have to, you know, defend Rich's honour. How do I say that in Scottish? It sounds so much better than Scottish accent.
Honour.
Yeah, there you go. So, on that note, 5 minutes to go, Rich. Shall we take a look at the markets? Just very quickly.
Let's take a look at your trade this morning on Glaxo. What's the latest update on Glaxo?
So Glaxo, I went short, and although it's not much, I've crossed the black line. Oh, I'm not going to close it. I'm going to show you where is my Glaxo trade? Come on.
1538.
Yeah.
Trading now.
And so I had I went short on this, and I'm looking at 1530. Let's call it 1530.
That's your target, isn't it?
Yeah, that's my target. And then I also placed a trade in on oil. And this one might be one I sit on for a few days, but that one I'm going long. My target for that 73.79, about there.
Was Whitbread one of the ex-dividends this morning?
No, it was Kingfisher. Kingfisher, the owner of B&Q.
Right, because we got Whitbread down 3.7%. Big shout out to one of my good friends, Jamie Goldstein, who is watching the show for the first time today. So Jamie is great. He teaches me all about Whitbread. He's in the hotels business and very knowledgeable. Teach me all about the sales per square foot and the average client spend per hotel room and all this kind. It's such a fascinating industry. It really is.
I love Whitbread. Can you tell Jamie I love Whitbread? Because did he tell you about the amazing business model as well?
No, go on.
So Whitbread, to my mind, are really clever because they buy these sites that are cheap but easy for you to drive to, right?
It's Premier Inn, isn't it?
Yeah.
Yeah, Premier Inn.
And love a Premier Inn. It's like you know what you're going to get.
Yeah.
Yeah, you just go there, you've got like a hen do, stag do, right? Wedding, anything, right? And you just need somewhere to crash for the night. Nothing fancy, clean, you know what you're going to get.
That's it.
And the Premier Inn is cleverly parked on, have you noticed, is always paired with another brand that Whitbread owns. Come on, guess. Trader friends, if you're on listening right now, guess which of these brands is owned.
Did they used to own?
I don't think they've sold it off. Have they?
Well, I don't know if we're talking about the same thing, but if it's something that we both enjoy drinking in the morning, they managed to get rid of it in 2019.
No, not that one. I know they got rid of that, which pains me a bit because I thought it was a good company.
Yeah, that changed the growth pattern hugely for them. Of course, talking about cost of coffee now.
Also, they do good coffee.
It is, and that cortado. Oh.
Unlike some of the others. So it is Beefeater and Brewers Fayre.
Oh my goodness.
And
I haven't been
now,
in one of those
Trader
for
friends,
years.
every time you drive, but it's clever because they don't want to do, they don't do your breakfast, right? It's not going to be like Four Seasons buffet in KL or Singapore. Let's be honest about this, right? They want you, wham, bam, thank you, ma'am, get out, right? Done, finished, gone. So, right next to every one of these Premier Inns, they've put either Brewers Fayre or Beefeater. Because if you're too hungover and you just like need something to get you to the car, you go to these places. Or if you have a family but you're too tired hiking or cycling or whatever you're doing, and you just need to crash somewhere to get some sustenance before you sleep, they've got these brands that they've cleverly put beside.
Is the carvery, is that where you get the carvery? Because I remember we used to go to a beefeater at university, so we're talking late 90s here, and there was a special carvery day. I think it was $6.99 on a Sunday. So none of us, we'd go for our long run on a Sunday morning at Loughborough, and then we'd all go to the carvery about 3 o'clock, and we wouldn't have eaten, and it was eat as much as you want.
There you go. That's
and
it.
I think, was that Beefeater? I'm pretty sure it's the Beefeater, yeah.
They do these breakfast deals and everything. I just think it's very clever. And they choose cheap sites, right? Cheap rental. And there you go.
But we still haven't found out why they're down 3.7% today. So
Message Jamie right now.
Let's
see what's going on with Whitbread. Because maybe, is it ex-Dividend? Let's see. News.
No, I don't think it is. If anybody knows why Whitbread's down, please drop us a comment there.
Yeah.
So that's take a very last look.
Yeah, have a quick look at the all sessions, because we're being told now stop having fun because we're now causing the directors to work overtime. But in terms of all sessions, you can take a position before then. Beyond Meat, all sessions down 2.7%. Novo Nordisk, up 2.7%. Novo Nordisk and up 1.3%. JD.com, we're seeing some of those Chinese names bounce back. Novavax up 1%, and Tesla up 0.75%.
What price is Tesla now?
It is now at 24278.
Okay, $242, right. So where is Tesla tomorrow? 242 bucks, 243, let's say.
You're gonna make me do that and whisper thing again.
Well, I'd actually quite like to see what the implied is on the options.
Yeah,
so
go
I'm going to producer Fred is banging his head on the table. Says this
These people have
show
no
finishes
time-keeping
at
skills.
10 a.m. Why are you bringing up a new trade? Right, so our 11th of October expiry, at the money, the vol is 115. So we're looking for at least a 6% move tomorrow in Tesla.
Wow.
Which way is it, up or down? What do we think? Up or down in Tesla? Drop us the final comment in the YouTube chat. You can receive, if you wanted to sell there, you can receive, $15.
Wow, that's a
wow. I'm not brave enough. Why am I looking at Tesla? I never trade Tesla. Don't tempt me in.
It's good that you've given me the implied probability. So now I'm kind of thinking, whichever way it goes, it could be 6%. Was that right?
About 6% move expected in Tesla tomorrow.
Yeah, it's a really tricky one because it depends on. Friends like goodbye, curtains.
Au revoir, everybody. Enjoy. I've been Rich McDonald, the wonderful Angeline Ong, who's taking me to the Shakespeare Globe this afternoon. And big shout out to Teach First and all the kids we're going to be taking along there. They will be in the studio tomorrow, probably not for the show. Have a good day all.
Wednesday, October 9th, or so they say, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called, a little show called The Price of Truth, a podcast where we like to explore the incentives that govern our world. It's very simple on Wednesdays, my friend. My friends have a great mind come on and share great ideas. Today we have with us, as we do every Wednesday, the great, the one, the only, the head of Global Macro here at Tasty, Mr. Ilya Spivak. Ilya, how you doing, my friend?
Good. Good. I'm anxiously awaiting what will be my Super Bowl for this week.
What, CPI
CPI
tomorrow?
numbers? CPI numbers are coming up. We'll see what it does. So far, my idea that yields are going higher and so is the dollar and rate cuts are going to fade. It's working, but it's not killing stocks. So something's going to happen tomorrow. I might have to flip over my positions.
Nominal price go up. Nominal number go up.
Yeah.
Even if real returns do not. More on that
Something's
in
going to
just
happen.
a bit. Ilya, it's great to see you. Before we get locked and loaded here, we've got a lot to talk about in our newly extended 90-minute Wednesday conversations, which surely will not be enough. We should say what's up to the people. Shout out to everybody watching on tastylive.com, as well as those of you watching on Tasty Trade desktop and mobile applications. I said this yesterday. I'll say it again. If you're watching and you don't have both of them, you're kind of a grifter. go support go support those apps. But if you want to be part of the conversation and get your screen name and your fancy questions and your funny comments and your dry, witty remarks up on the screen, there's only one place you can do it, and that's on the evil Google YouTube. So head on over to YouTube, type in Tasty Live, find our channel, go to the live tab, and you'll find this big inflamed head on the thumbnail somewhere. Click, enter, introduce yourself, tell us where you are watching from. Tell us whether you're long, whether you're short, questions you may or may not have. Tell us how much you enjoy looking at Ilya's hair or hearing the sweet dulcet tones of my voice. Just say anything, any random ass characters to spoof the Google algorithm and to put us in front of as many people so that we can save the world one view at a time. Shout out to everybody that is in the chat. Brian, I saw you. Absolute Beginner, Cato Prime, Lone, VDub, and so many more. I would shout out all of you, but we've got the one and only Ilya Spivak, and so we're going to utilize as much of this 90 minutes with him as we can. Ilya, I'm going to go open-ended, my friend, as I like to do at the very beginning to get us started.
Yes.
Just give me your general sort of take. This is 2 days in a row on a generally bullish tape, 2 sessions in a row, generally bullish tape. Slow the interest rates. It's in particular the longer end of the curve, just leaking a little lower, not really doing a lot of damage here, but leaking a little bit lower in the last 2 sessions. And some reprieve in the commodity end of things here today. So your thoughts on the risk action the last 2 days?
I thought that yesterday was kind of whatever because we sort of stayed within familiar ranges, but today was very clearly more convincing. We took out the highs. We didn't take them out quite in NASDAQ, but we did in S&P, and certainly a closing high in NASDAQ relative to where we closed before back in late September. So there seems to be some sort of a positive disposition here that's emerged. I'm still positioned a little bit for weakness. It is as ever with put verticals. So my risk is very locked in and I'm very small. I'm in MNQ and in MES. And that's at this point a very small part of my overall portfolio. The big bets that I've had on for the past several weeks have been long dollar and a little bit short gold, and those things are working. So at this point, the equity upside has been a bit of a fly in my ointment here, but I'm looking to see what happens next, and I'm willing to let it ride into tomorrow. Because I think what we saw here today, you mentioned that the long end was a little bit slower, and it was. We got slightly higher yields at the long end. It was more sluggish at the short end. We've mostly been just consolidating for the past 2-3 days at the short end. This is a big deal now. The thing that keeps me in these shorts, for lack of a better kind of setup here, is if you look at the S&P, so ES weekly chart, past 3-4 weeks, what you see is this perpetual slowing in momentum. So look a week back. That was the smallest increase in 5 weeks? And you slowly are getting this momentum fading from the week before the Fed, which is that big green bar, the rally after the big sell-off. And then momentum just kind of slows and slows and slows. And you finally get a little life in it today. But why it's slowing, why it's not going faster given the news flow, that continues to kind of make me somewhat suspicious. The Fed gave the markets everything they want. They gave them the 50 basis point cut. They gave them all of the dovishness that the markets had endorsed in Fed funds futures pretty much. At this point, and the markets believes it. So if we look at what Fed funds futures have done since, yeah, they've shaved off some of where the markets were more dovish than the Fed for next year. But still, they're endorsing the Fed's sort of dovish SEP here still, for the most part, even with the adjustment in yields. China unveiled stimulus. Granted, this week we have some suspicions around how much confidence that's engendering. But what happened last week? What happened the week before? Chinese markets were screaming. All the optimism was there. Nobody seems to really care very much about the geopolitics because the spread between the Brent crude oil benchmark, the European one, and the US WTI benchmark has been going down, not up all year. If there was a supply disruption because of the Israel, Hamas, Hezbollah, Iran shenanigans, or the Russia-Ukraine issue, it would be a disruption to European crude. It would become more expensive. The spread would widen. Not only is it not widening, it's below its long-term average, and it's been going down all year.
Is it like $5 or something?
It's like 4.5, 5.
Yeah, okay.
And now it's sub 3. So it's above 3 currently. It dipped a little, but even the 20-day average is higher than where we are now. So we closed today at 3.3. The monthly average is 3.6. The 9-year average, going back to 2016, is 4.01. And the really long-term average is closer to 5.
So five represent, when you get into 5 territory, you're now seeing that's an expression of likely geopolitical premium that's priced in. So
something is either the U.S. has suddenly discovered that there is an ocean of oil somewhere, and so WTI has crashed.
Yeah.
And by the way, we talked a little bit about this last week. The U.S. now produces more petroleum than Russia and Saudi combined. So we are kind of sitting on an ocean of oil. But either WTI would crash or Brent would go up, and the spread would be something like 5, and you'd go, okay, something's off. If it's over 5, something's weird. So you put all this together and you go, okay, the world's top 2 economies are stimulating with vigor. U.S. economic data has only grown better over the past week and a half.
Right. More positive.
Very strong service sector.
There's less negative surprises to economic data over the last couple of weeks.
Yes. So the U.S. economy is getting stronger. The top 2 economies are delivering stimulus. Nobody's worried about the geopolitics, and the S&P momentum is slowing. Why is it slowing? What's wrong? The only thing that I can think of is that yields are higher because nothing else is broken. So you get this CPI number, and it's obviously very relevant, because if the only reason that the markets are kind of not as dramatically bullish as they could be is yields, well, then the CPI number is very impactful there. So I'm going to watch it closely, and especially the core. The expectation is that the core is going to hold unchanged for a third month. We know what happens when you hit the magic 3 months stuck thing. We saw it from the Fed earlier this year, right? 2 points don't make a line, but 3 points do. So when the Fed looks at this and goes, okay, 3 is a trend, and that means maybe we need to, at least the markets might think they could dilute how much they're going to do next year. Does that mean the long bond goes up more? Or does it mean that it falls? Does it mean that yields continue to push higher?
What would you guess?
We're going to have to see. I think my worst case scenario for stocks, best case for me, because I'm a little short, would be, and because I'm long dollars and because I'm short gold, I think the kind of scariest version of this.
You're short gold? That's new. I'll work more on that later. All right.
Yeah.
Sorry.
I put it on this week, early this week. So I think the worst case scenario for risk is if CPI comes in basically as expected and stocks can't make hay of it. I think if you get numbers that look like they should be priced in, that should not be an issue, that should basically tell you everything is fine, now just look at the economic data. If you were to get inflation that doesn't look scary and yields can't come in and risk is soggy and the dollar is strong, that would be a very, very loud disconnect from what the markets should be doing and give you a sense of significant underlying weakness. That would be more scary than if the CPI were hot and yields went up, because that would just make sense. And I think there is upside risk there. The price component in ISM was the strongest in 4 months, 5. The wages number coming out of the jobs report, surprisingly higher, the highest in 4 months. There's reason to think CPI, especially at the core, could surprise higher. And if it does, it'll be really important to watch what the long bond in particular does.
That's funny. I've been wrong on directionally on CPI. I think I was last month.
The core or the headline? Because they've diverged a little.
It was more. I can't remember where I was thinking warm or cold, but this time around, I think there's a probability. I like the odds. Put it this way: I like the risk and reward of what the potential of a cold number, like a cool CPI number. I like the potential there, or the risk and reward that presents. I guess my question to you is, and I know this isn't the way you play it, but I'm going to ask the question anyway, just to see what you do with it. If you did get a cooler than expected CPI number on either core headline or both, what's your spidey sense say how the market responds?
Dollar weakens, bonds go up, gold goes up, stocks rip.
Do you think, in a way, some part of me thinks that the markets over the last 2 days, that's the lean of the market, and that some of that upside is being sort of captured
in the 2 sessions prior to CPI. In other words, if the
You just hit the nail on the head.
So yeah, sometimes I think the market sort of plays their hand. They tip their hand, and so some part of me has been expecting that this is going to be cooler than people expect, and that the market in a way is positioning for a cooler than expected number, which then changes the reflexive. What does the market do after you get it? After you've already got a 2-day rally, then there's a whole question. So your opinion is the market's leaning here towards a cool number, or not a warm number, I should say.
In equities, it seems to be that equities is leaning in the direction of this will not be scary. Because if you look at the dollar's continued to go up. Bonds have continued to go down this week. Gold started to crack down, which is why I sold it. It seemed to top, at least near term, if you look at the price action. All of that seems to suggest, and we'll get to gold, I'm sure it's a multi-dimensional sort of thing, with geopolitics as well in the mix there, seemingly. But all of what we've seen outside of equities has been reflation.
Right.
So higher yields, stronger dollar, weaker gold, reflation. Equities, for their part, until today, were essentially twiddling their thumbs. And then today, maybe they took a little bit of heart from those FOMC minutes that didn't freak anybody out because there was nothing really in them that was terribly actionable, although there were some interesting things that were said in there that bear keeping in mind. I think equities seem to be saying this is not going to be a bad thing, which of course creates the risk that you might get numbers that are basically in line. And if the markets don't then rip, if it turns out that they've already baked it in for the past 2 days and there's nothing else there, oof, that's not a good signal.
Yeah, it leaves for some interesting intraday volatility. I don't know whether it's like meaningful over a multi-day period, but on the intraday you could see interesting swings. So then, okay, let's game this out, because I think this is why I love talking to you. So the market right now has got about a 30% chance of basically no cut in November, 70% chance of a 25 basis point cut, if I'm not mistaken. I think that's about where we are right now. 1 in 3 chance of staying where we are.
Yeah, and overall, by year end, we're looking at about 70-ish% now that we get the 2 cuts that they gave us.
Yeah, cumulatively. So, but I'm just, I can't walk and chew gum at the same time. So I'm just thinking about, I'm going meeting to meeting here.
Sure.
So what do you think a cooler than expected number does to those odds?
I think you get a cooler than expected number, and the markets basically lock into what the Fed has essentially endorsed, which is 50 basis points before year end, which is a quarter point at each meeting, November and December. I think that we're even unsure of this seems a bit silly, since Powell basically told everybody to look at the SCP and said, well, so where are we going next? Look at the SCP, the man said.
That's so wild because he hates that stupid piece of paper.
He hates that thing. So I was looking at the other thing that everybody seems to hate, but which was actually pretty useful this time, the dot plot from the last go around. And that thing is maligned by anybody that's ever talked about it seems. But it's an interesting setup because the level of conviction in where rates are going for the rest of 2024, if you look at the voting, very strong. Out of the 19 of them, maybe like 90% are clustered at the forecast. So I think that the next 2 meetings, almost on autopilot. Something really bonkers would have to happen. But
interesting.
Next year, I think, is the bogey. And when you look at their voting pattern for next year, only about 30% of them are directly on the median forecast. So the dispersion is much greater. The diversity of thought is much greater. And even if you expanded it out and said, okay, how about within 50 basis points of forecast, right? Because the Fed is setting rates in ranges. So what if we go within 50 basis points of the range that they imply? You go, okay, stronger consensus, maybe like 63%. Think it's going to be between 3 and 3.5% next year on Fed funds. But the way you get there, that slight difference of just saying, okay, what if it's a 50 basis point leeway I'm giving myself in terms of getting the forecast right versus 25, that 25 basis points has huge market implications.
Mm-hmm.
The outlook moved basically the equivalent of one cut less dovish last week, and we had the biggest bond rally in 2 years. So that difference is a big difference. And you look at the dispersion here.
Biggest bond rally?
Yields, the biggest yields rally. Biggest bond sell-off. I'm constantly back and forth on getting this thing wrong.
We've been doing it for a long time, and even we can get turned around on yields versus
I'm like,
price.
what am I talking about now? Which instrument am I talking about? The yield or the bond?
I do that all the time. Sometimes I'll say selling or buying the long end. And when you say that, long end sort of implies you're talking yields, but I'm saying price. I do stupid stuff like that all the time.
Yeah.
Anyways.
But yeah, biggest bond sell-off in 2 years.
Mm-hmm.
ZB held up a little bit better, but ZN, ZF, ZT got absolutely cooked. And we had a meager, maybe 30 basis point move in the Fed rates path through next year if you look at what Fed funds futures had last week. So small changes. You lose a cut, markets really notice here. Mm-hmm. So there's a lot of dispersion for next year, lots of diversity of thought. And the minutes that we got today,
I'll get there. Yeah. Hold on. I want to go into it.
They fed into all of this. Powell's speech last week fed into all of this. Things could go awry quickly if you repriced even a little.
Agreed. So just to put a finer point on this one and to move on to the minutes real quick, the general thought here is that a cooler number stamps the 25 in November, probably stamps. It opens up the window for them to continue to act in the short term.
Yes.
And it could stamp a 25 November and stamp a likely probability of a 25 in December. The flip side really
and maybe lock you in for the full 100 for next year.
Okay. Flip side then is a warmer than expected number.
Yeah.
How does that? What do you see happening in that particular case?
There is what I see the markets doing, and then there's what I think is going to happen. So I think with what the markets do is they mark down further the likelihood of getting both of the cuts this year. I think they go closer to one. Maybe they even push it out to December. I'm looking at the cumulative tally between this year and next year as I think that's more instructive. Sure. Because I think the Fed has kind of painted itself into a corner with November and December. I think both of those cuts are coming. I think it's not really
meaning
a
it's
data
just
question.
Are you doing 25 or are you doing nothing and then 50 type situation?
Either way. Mm-hmm. Either way. I think 50 more this year, you'd have to have something really out there occur for the Fed to walk that back. Mm-hmm. Next year, though, I think you could get much less if you started to get reflation really spooking the Fed that it's not going to get to 2% when it wants. So, but from the market's perspective, they're very kind of what's directly in front of me sort of thinking. So I think you get a hot number, yields go up. They go up at the front end. They go up at the long end because the markets basically go, the cumulative stock of easing will be lower, we're not going to worry very much about what the dispersion is. We're going to mark down how much for this year. We're going to mark down how much for next year. We're going to take the total tally down by, let's say, another 25 basis points.
I think we invert again.
Maybe.
I think we get more bear flattening. I think the short end would raise more than the long end.
Very possible.
As a sort of first point, and then okay, let's see what the Fed says from here. So the long end will say, let's see what they're saying about this, because we're going to take out some of these cut expectations, and if that's right, I think that's probably the first move. We invert more, and then whatever we get a blessing of whatever, or a rejection of whatever that move is, then you see the long end sort of make a little bit more heads or tails of what the short end has just done. So I sort of think that would be the potential case.
I can totally see that.
Why am I talking about this? So the reason I'm talking about this is I think these CPI numbers, for me, they tend to be more directly related as a movement catalyst to bonds and the yield curve. And so I like playing that. I think if you told me what CPI does and then you told me what interest rates are going to do, I still don't know what the hell stocks are going to do relative to these CPI readings. So I think they're great catalyst to create equity volatility. But from my point of view, maybe you guys have a better read than I do. I feel like the correlation of trying to figure out how equity prices move relative to an inflation figure, to me, I feel like there's very little read through. It's really impossible. So I like talking more about what do you expect bonds and interest rates to do. Then that prepares me not to say I'm going to take a position beforehand, Ilya. It's more or less, if the first move doesn't align with what I think could happen, well, then I might be getting a decent price. If we go down and if the yields go down and I thought they should go up, well, then I might take a stab. I'm getting decent risk reward. Or if I thought the opposite. So I'm just preparing myself for a trading plan going into the day more than I'm trying to predict what CPI is going to do and what interest rates are going to do. Do you kind of
which you should never be doing anyway
the same way?
Yeah, I think trying to predict binary events is a fool's errand. I think what you're much better off doing is benchmarking what you think the surprise risk is, because that's where volatility comes from. And basically saying, do I have a risk reward setup that makes sense for what the risk is?
That's what I do. I don't try to predict it. I just go, where's the favorable risk to reward? Even though I might have a low probability, do I have a really interesting risk to reward?
Yeah.
If everybody's on one side of the expectations and the market pricing is already validating those expectations, in those cases, it's not that I'm predicting something. I'm just saying, if I have a position on into the binary event, I'm just saying there's a risk and reward opportunity here that I see. And if it hits, it hits. But if not, I didn't predict it. I just felt the pricing made sense.
That's why my equity exposure is done with such rigid risk controls. That's why I've locked in 1% of equity in max loss for these put verticals that I have in MES and MNQ, because I don't want, I'm very cognizant of the fact that I'm betting on a market that does not want to go down. Very cognizant of that. And that has shrugged off all kinds of headwinds. But I'm looking at this now and going, well, okay, all the news flow is going your way. Why are you slowing? What's wrong with you here? Are you just jittery ahead of the election? What is it? And so as I look at this, I go, okay, the only odd thing out is that yields have gone up since early September, because already before the Fed even made the announcement, right? Obviously, we knew the cut was coming in September. Powell said it as much in early July, and they've massaged it and massaged it and massaged it. Nobody didn't know that the Fed was going to cut in September. There was some conversation about, is it going to be 50, is it going to be 25? There was a little dispersion there, but the cut was coming. And what we saw since early September, with full knowledge that September is going to have a cut was a steepening of the curve because the markets already knew, and long yields started going up. Gold started hitting record highs. The bond market, the break-evens in the bond market rose to the highest in months. The market's saying this is reflationary. And yields have been going up since. So that's the only thing I can think of here that really should be holding anybody back. That's why I think this CPI number might be a working catalyst for equities. But, and I mean, let's talk out of both sides of our mouths here, because obviously, who knows, right? We're trying to divine the future. Every single time that we've had something hawkish come out in the past several weeks, Powell speaks, it's a little hawkish. ISM comes out, it's a little hawkish. NFP comes out, it's a little hawkish. The minutes today have some shade of that, very, very narrowly. Markets, stock markets, that is, they get annoyed for a bit. Sometimes it doesn't even last an hour, and they come right back. So I think watching not even the initial reaction necessarily to this CPI, but where the dust settles tomorrow, that's what I'm interested in.
Why
do
you think
we
that
actually
is?
get some follow through?
Why do you think that there is a level of optimism here at 5,800, that there are people moving up their upside target equity targets from 1,000, in some cases up to 6,300, so on and so forth? Like, do you think this has a lot? Do you think people are pricing in not only current liquidity conditions, but the very real likelihood of conditional liquidity additions, both from our central bank and others, that we are in a rising liquidity condition market? And in that world, why fight nominal prices? Do you think that has a lot to do with the optimism here? Or do you think there's something else going on?
Well, the reflation dynamics that we've seen across markets would certainly seem to suggest that people are looking at these rate cuts, not just from the U.S., but certainly mostly from the U.S.
It's not just rate cuts, right? It's the fiscal. It is governments also pumping money.
Oh, for sure.
Economies, whether it's domestically, we know what we're doing here, right? We also know what China has just proposed and has started to do, and so on and so forth. So it's not just
well, they haven't started the fiscal part, but yes, in China so far, it is only
made the announcement.
Monetary policy, kinda. Which is why
I'm talking about the $284 billion in bonds. That was an official announcement. Hasn't been executed yet.
Yeah, and even that I think is still there. There's been chatter that they will issue these bonds, but they haven't issued them yet, and they haven't made an official government announcement that they're going to issue them. And the number is a little small. It's only about 1.5% of GDP, and you keep getting these analytics from IMF, from The Economist, from this place, that place, saying what they really need is like 3 to 4% of GDP if they want to put through enough demand here. And so this week it's down like 20% off the high. So obviously that's eye-catching that they were off for a week for their New Year's holiday, and the day they come back and see where markets are, the first thing they do is sell them down by 20%. I think that's not to be missed. But nevertheless, to your point, there is reflation indication all across these markets. And the strength of the U.S. economy now, as evidenced in this most recent data, that shouldn't hurt. That should help. We've seen this movie also. Recall January, right? Rate cut expectations started to fade. We came into this year going, Fed's going to cut 200 basis points this year. And then U.S. economic data started turn up in January and February, and the markets went, okay, nah, that's too many cuts. And stocks rallied anyway, because we were shedding cuts for good reasons, for growth is faster reasons. Now, maybe the markets are looking for a redux, and they're going, okay, well, we know how this works. If the economy is heating up, yeah, we'll get fewer cuts. But is it bad news that the economy is heating up? Not really. Why? So the affordability crisis is improving. If you take CPI and average hourly earnings at face value, we might see that in better consumer confidence when the University of Michigan publishes those numbers on Friday. Job creation is faster. The revisions were even better in the last report for August and July, which is a change of pace. They had been tending lower. So if the U.S. economy is heating up, is that really bad news? That might be, it might not just be liquidity. It's also, even if you have less liquidity support, you have less of it for good reasons. So maybe that's a good thing.
And
but,
also in a way, the Federal Reserve has shown you that when the risks are balanced, which direction they seem to want to lean, right? And the lean is to accept higher inflation than their target for some interim period versus damage to the labor market.
Yeah.
And so if that is in fact the lens through which our central bank is viewing the world, then wouldn't it make sense in a rising liquidity environment to, there's for all the risks that are out there, and I know there are many, my friend.
Yes.
I'm just asking the question, what would convince somebody to put an incremental dollar at highs? And it just seems a rising liquidity condition coupled with a monetary policy that seems to be favoring a rate of inflation above target versus any damage to the labor market, like that seems to be a reason, right? I don't know if it's good enough.
I wouldn't even say an inflation rate above target. I would say, because the Fed thinks about these things in quote unquote the medium term, and the only central bank I've seen define what that means is the Reserve Bank of New Zealand, which, by the way, also came up with the 2%
what they say
level.
5 or 10 years. What is it? What's the medium term?
Medium term is 2 to 3 years. So if that's what they're looking at, I mean, they've been wildly successful. They've brought inflation down from, let's call it, close.
They brought it up.
They've brought the inflation measure that they benchmark policy against, because we have to talk about not hypothetical variables, but real variables that are actually being used by the central bank, right? We don't ultimately care what the variable says. We care about what the central bank is going to do and how the markets will respond, right? It doesn't matter from a practical trading perspective whether your measure of inflation is CPI or PCE or trueflation or whatever you like. That's not important. Who cares? What matters is we know what the Fed benchmarks to. The Fed wants to get PCE to be trending to 2% in a 2 to 3 year window. It is doing that for sure at this point. And so from the Fed's perspective, a year and a half ago, it was trending to like 6, 7, 8. And now it's trending to 2. So have they achieved that which is their mandate? Well, they're very, very close. But the progress they've made has been incredible. And so when you look at sort of the practicalities of this, the Fed's been doing what it needs to do to deliver on how it defines its goals. It got cold feet about the labor market. It started cutting. Economic data was getting worse from about mid-April or so until now we can see late August, early September is when the data seemed to start to really begin to warm up. And obviously at this point, it's unmistakable with ISM service sector growth at 19-month highs. It's huge. So you look at this and you go, okay, the Fed's thing here is if core inflation stops going down, then their medium-term window stops being as easy to hit. It might take longer, whatever.
Yeah.
And so they're going to cut less. I think that's the bottom line.
Yeah, I agree with that. I could sidetrack us there, and I could sidetrack
I'm here
us
for it.
and
Let's
talk
go.
about how you're championing the arsonist for putting out the fire and saying they're doing a good job in doing so. But we've got a lot to cover.
I'm a degenerate Fed apologist
I know
all day.
you are, man. I know you are. All right, let's do this. But we've had that conversation before, so let's go into new territories. As much as I actually enjoy those friendly little spars with a gentleman who's probably forgotten more about the Fed than I know, and I admit that. So let's do this instead. You've been, and I think rightfully so, a bit skeptical of the China rally for several reasons. One, the economic data is not necessarily signaling that there's a turnaround in the economy. In fact, probably less so. For the reason that you've been an investor in this region for a very long time, and the patterns that you've seen in the past is you can get a positive headline, but unless you see meaningful follow through and execution, be skeptical of those headlines. And the third reason is that the announced monetary and fiscal stimulus, I think in your mind, up until this point, has not been really big enough to ease the concerns, I think, that you've seen and that many others that follow this region have seen. For all of those reasons, right, you had the Golden Week, very low liquidity, and you had this opportunity for this massive run. In equities, it looked nasty 2 days in a row. Yesterday, it looks like they have after that meeting. I say yesterday, it's probably 2 days. I forget, maybe 2 days ago. Where for whatever reason the market wanted an announcement of new stimulus, which is hilarious. Didn't get it. We go on a second day in a row it was looking nasty yesterday in Asian markets. Then they announce a new meeting, a scheduled press conference for Saturday, and just like Pavlov's dogs.
Smoke and mirrors, baby.
You're telling me there's a chance. You're telling me there's a chance. And so it stopped the bleeding a bit. I think some of the Chinese stocks today traded lower, but at about 2% versus maybe the 4 to 6% sell-off in the past. Your point of view, vol still elevated here. Your point of view on either FXI as a whole or GXC, EEM, whatever is your preferred instrument here. Your point of view here on how to think about risk and the whole narrative in China.
So for me, just to quickly set this up, China has been attempting versions of monetary stimulus for basically the better part of 3 years, and none of it's worked. That was lost on no one. So when then the PBOC came out and said, we're going to have money for companies to buy back stock. We're going to cut the main lending rates. We're going to lower mortgage rates. We're going to lower bank reserve requirements. All of that is more and more and more easy money, easy money, easy money. Except none of it's worked for 3 years, so why would you think it should work now? Easy money is there if people want to borrow. But if they don't, they're not gonna. And if they don't want to spend, invest, consume, they're not gonna because rates are low. That's been the issue in China. The inducement that is cheap money has not induced anyone to do anything. The reason that we had this incredibly powerful rally is with the PBOC announcement as a separate thing. The core 24 people that run China, including Xi Jinping, had a meeting. It was off schedule. And they came out of that meeting saying, basically, we're prepared to do fiscal stimulus, not inducement. We're prepared to create demand, to spend money in the economy. That's why everything ripped. Now, while the PBOC gave specifics, this is how much money we're going to spend on this. This is how much money we're going to spend on that. This is how much lower the mortgage rate is going. This is how much the 7-day rate is going down. This is how much the 1-year rate is going down. All of that. The Politburo didn't say anything specific. But the markets, which are sitting here on tenterhooks going, come on, fiscal stimulus, it's the only thing we've got because we need demand. And the private sector isn't doing it. It's not taking the bait. It's not responding to monetary incentives. We need fiscal demand. Soon as the markets get a whiff of this, everything runs. And the low liquidity during Golden Week, I'm sure, helped quite a bit. But it also helps quite a bit that these are mainland stocks, which means Xi Jinping can basically order them higher by decree. Where my skepticism came was you were not seeing the markets outside of mainland endorse this at all. Aussie dollar didn't rally. Copper couldn't sustain a rally. EM excluding China, EMXC, couldn't rally. That index is made up of tons of countries whose economic fortunes depend on Chinese demand. That should have rallied. Nope. And so it wasn't confirming for me. And it seems like what happened at the beginning of this week when China came off Golden Week and liquidity rebuilt in earnest was it wasn't confirming for them either. Because nobody has said anything specific. Nobody has actually put any meat on the fiscal stimulus bones here. And if anything, the commentariat has suggested out of Beijing that maybe the market is overcooking how much spending is actually coming. And even that is being looked at as maybe light, even if it were exactly as expected. So I look at this now and I go, I don't want exposure in FXI. I don't want exposure in ASHR. I don't want to touch mainland stocks because Xi Jinping can will them higher. But I'm also not getting out of my short Aussie dollar position until I have a good reason to get out of it. I was thinking of how I might take bearish exposure in copper and ultimately landed on the ETFs we don't have on the platform because they're not liquid enough, especially in the options. And the HG contract is too big for the way that I manage risk. It's just too much exposure. So I've stayed in Aussie dollar, or else I'd be shorting copper as well. That's working, but I'm not participating. I'm hypothetically bearish, but in Aussie dollar, I'm very, very not hypothetically short. Outright M6A futures, and that's working. So this I still have. And that's the way I have my exposure. I want to be trading a reflection of this story that captures my skepticism of what China is doing without standing in the way of an asset that His Imperial Majesty, aka China's president, can just say, make this go higher, and they do.
So your opinion is you don't want the long exposure. You're not necessarily fading this particular market, given the potential right tail risk of a government who, if they want it to go higher, can do so by decree. My personal opinion and my book towards this is I'm long with collars, which is effectively a synthetic vertical spread. So
Yeah.
I've had long stock exposure for a while. I thought the valuations were too stupid not to want to participate.
That
And
makes
these
sense to
things
me.
traded sideways without a ton of pain. I mean, depending on when you got long these things, they were trading sideways. There was opportunity cost, but not a lot of real capital depreciation. And so after this bump, to me, I think let me collar up my positions, protect some of the capital appreciation, and see what develops from here. One of the other things, I guess, I'm not as into this, but is it rare for them to start talking, the Politburo, is it rare for them to start talking about monetary fiscal stimulus towards the economy at this stage? A lot of things I'm reading and watching is that normally when they meet, they wouldn't necessarily be talking about economic issues right now.
Right.
They would be talking about other issues, and it's not until December or the end of the year when they would
Yes.
actually be making announcements about the economy. So the fact that they're even having these discussions is a bit of an anomaly, but perhaps
Yeah.
the market's getting ahead of expecting when you might get further detail on economic stimulus, because that wouldn't technically come normally until December. Is that directionally right?
Well, they're afraid. They're talking about things that they normally wouldn't be talking about at this time of year because they're afraid that they're not going to hit their growth target by year end. And if there's anything you can't afford, it is the optics of weakness if you are a totalitarian regime, because the fundamental trade-off in China, as it is really for any authoritarian regime, is we give you prosperity, safety, and stability in exchange for we get to do what we want, and you don't get to do or say what you want if it clashes with us. That's the fundamental bargain. And in China, there's a long, long history of making this bargain and breaking this bargain. China is a big, big place. And for a lot of its history, it was not the united polity that we're looking at now. Even what we might call sort of core China, the quote unquote middle kingdom. Even that, it's fractured into parts and statelets countless times. When a dynasty fails, it's because it's failed to feed and employ that mass of people.
That's a two-way message. That's a two-way street, my friend. You can be talking about lots of governments right now.
In China, the history is obviously very, very long. We know how this works in China. I'm looking at this with a similar lens as I look at Russia, where in Russia, you've had a czar, you've had a commissar, now you have a sort of corporatist, capitalist czar, but you've always had a czar. And there's always been this kind of dynamic. It's the flavor that's different, but the general social contract remains. It's very similar, I think, in China, where yes, the current dynasty is a red dynasty, but it's a dynasty of China, much like the others, in broad strokes. And Xi Jinping, I think, understands this more than anyone, because everything he's done has been to consolidate power, to humble the elites, to make them understand that having more money does not mean you have more power. Notice Vladimir Putin did the same thing when he came to power. He humbled the oligarchs first.
I'd like to throw some of our oligarchs in a dungeon somewhere and do some re-education. I wouldn't mind, give me a dark cement walled room and a couple of torches and 2 weeks with Zuckerberg, and I think we'll have a very different world when we come out of there.
Since between the two of us, I'm the one that comes from the Soviet Union and left it on purpose. I would point out that I am now and forever a loud advocate of the rule of law. and not for those kinds of things, because I've lived them. So
Fine line.
grew up
We got to keep the oligarchs in check.
I grew up in that
system.
environment. I grew up in that environment, and that we don't do that here is a blessing 10 times over. But China is not in that space.
Zuckerberg could catch these hands. I'll tell you that much.
Man.
I don't care
listen, did we or did we not lose Jack Ma for a while there? Wait, where did he go?
Lose that for a while.
Where did he go? So, so you look at this and you go, okay, Xi Jinping understands this. He's purged everyone that didn't agree. He's really clamped down internally. They've been more aggressive externally, but internally it's been even harder. I mean, Hong Kong is getting put to heel lest they thought that they could do what they wanted. So there's been a real clamp down in China saying, we are not going to lose this dynasty. We are not going to let you people decide who runs this place. It's going to be us.
Two-way street. You could be talking about a lot of different places right now.
I'm saying,
bro.
and if they lose the economics bargain, if they can't meet the growth target, people are upset already. Remember how zero COVID ended. They didn't want to end zero COVID. People came into the streets, started burning stuff, which for China is outlandish. Outlandish. That people got to a point that they were like, yeah, okay, People's Liberation Army, shoot me. I'm burning things down. This is ridiculous. And they caved. The PRC caved. And that's a huge deal because that population is huge. If it were to actually rise, if the bargain economic prosperity for freedom is violated because the economic prosperity falls away, oof, we have a big issue.
We do, but that's
so they want to hit that.
That's why
they want to hit that target.
That's why I think Palantir is a much more valuable company.
I love that company.
Palantir represents control for governments. All right, let me get on to your gold, your new gold position here. I'm too chicken to fade gold. I too think that this is probably an interesting level to fade it. I don't have the stones, and usually I'm the one who's trying like pick tops and bottoms, and you guys will wait for price to confirm. You have gotten a rollover in price, but you haven't broken, I would say, the meaningful primary trend line. So talk to me about your thinking in gold and why you're fading it.
It's tactical. So I look at the most recent swing bottom where gold was consolidating, and I see that it's closed under that. And so I sold that, basically looking for a pullback maybe to the range highs that were prevailing April to June, July, and then we'll see. I'm not looking for a big tectonic change. What I am looking at, though, is look back, not this week. This week, gold started to roll over a little. Look back the past several weeks. Yields are screaming higher, and the dollar is screaming higher, and gold isn't falling. What? That's not what's supposed to happen. This is an asset that yields nothing, and that is the natural alternative store of value, sort of the natural foil to fiat currency, historically. Lord knows it's not Bitcoin. So when you look at this and you go, okay, gold should be getting crushed, and it's holding. Why? You look at crude oil. You look at crude oil. You see that crude oil comes off the mat at the same time and starts rallying. And you go, maybe this is geopolitics. People are once again entertaining that maybe Israel and Hezbollah are going to escalate. Maybe Iran is going to finally do more than theater. They shoot off another huge round of ballistic missiles at Israel. Israel hasn't responded yet. We'll see how they do. But maybe the market went, you know what, we're not gonna sell down gold here because this geopolitics situation is jumpy. Then this week, crude catches vertigo. Arguably because the third now, I think, leader of Hezbollah in as many
give
weeks.
It to you, man. You guys are clever. You always catch me with little stuff like that. And I'm a dad, so dads, we don't need much wit to break us
No, we
down.
No, we don't. The third leader of Hezbollah in 3 weeks at this point comes out and goes, all right, okay. Let's talk about a ceasefire. Whoa. And maybe that's a sentiment that's coming out of Hezbollah, but Hezbollah is so closely steered by Iran. I mean, unlike Hamas, by the way, Hamas is more a beneficiary of Iran support financially, training-wise, military hardware-wise. Hezbollah was actually created by Iranian intelligence back in the day. They seeded it. So that link is very close. And maybe this is Iran telling Hezbollah, hey, nobody wants this escalation. You're creating something we don't want. Because Iran has signaled endlessly. Pezeshkian, the president, just said it at the UN in New York. They don't want a regional war. They refuse to be dragged into one, he said. So, for whatever reason, Hezbollah is saying, hey, uncle, let's have a ceasefire here. Let's start a conversation. Crude oil falls, and gold ostensibly loses those things that have defended it against a stronger dollar and higher yields. So I'm looking at this and saying, okay, maybe there's a little catch-up sell-off here. It looks offsides, given where yields have gone and where the dollar has gone in the past several weeks. Maybe it just needs a little correction. Maybe we need to get down to like 2,400 and reassess.
2,400. You know, somebody in the chat just called, I think it was Noah McCormick. Shout out to Noah. Gold, 2,700, then 2,300. So it looks like you're kind of, I think they're at the support of the last move, whereas you're at the resistance. So we played between 2,300, 2,400 for a while before breaking out. And it looks like what you're doing is just saying if we break down to the downside, we could find support at the old resistance. That's sort of the idea.
Yeah, exactly.
What would you say to somebody? I follow lots of different people, right? For different markets. You know, if it's bonds, it's Jim Bianco, Bill Fleckenstein, and I think Rosie Rosenberg. If it's like currency and metals, it's you. It's Luke Roman, a handful of others, right? It's just I like following experts in their field. So, what would you say? One of Luke Roman's cases is that there will be sort of structural selling in U.S. Treasuries as people, big money pools, start to reduce Treasury holdings and increase gold holdings as a diversifier away from the likely increasing credit risk of the United States. What would you say about that structural bid to gold as portfolios are likely underinvested in this asset, and as you see them potentially start to move money there and divest out of U.S. Treasuries, that there could be this structural bid to gold? What do you say to that?
I don't agree.
Why?
I don't agree. I think the idea that the U.S. is subject, and by the way, if we were talking about not the U.S., it would make a ton of sense. But we are talking about the U.S. So I think the idea that the U.S. is subject to market discipline on its debt the way everybody else is a fantasy. We've been talking about this debt growing for 40 years. people have been crowing about this becoming a big, this kind of issue, that kind of issue. Nonsense. Where is it? Yields have only gone down. Only since COVID have we had an inflation issue, a global inflation issue, and interest rates from central banks all over responded, and yields went up everywhere to fight it, with some very small exceptions. China is an exception. Their economy is in deflation because they screwed up. And Japan is a debatable case. We'll see if the inflation sticks because their demographics don't support it. So we'll see how they figure this out. They've had basically no inflation for 40 years, and their demographics haven't become any better. We'll see if this inflation that they're seeing now, that they're responding to now slowly, is a thing that keeps going. But everywhere else, we had a structural decline in bond yields. If the U.S., with its ballooning deficit for 40 years, was becoming an ever greater credit risk, we would be seeing this a long time ago.
Could I make the argument?
Not going in the opposite direction. The only thing I would say is there's a reason why. And the reason why is there is no more eligible borrower in the world than the United States government.
Here's the flip side. The flip side, real quick, that I want you to respond to. I'm not arguing against your point. What I wanted you to do is just respond to this. The flip side would be the beginning of that 40-year time period is globalization and adding China to the WTO and everything that happens after that as a sort of a structural
give or
cause of
take
disinflation. Maybe the last 20 years of that, you have a structural increase in the Federal Reserve's balance sheet, which is buying up, is acting as a non-economical, price-insensitive buyer of that debt, which artificially lowered those yields. And at this moment in time, they're at least acting like they're not going to do that, and they're letting their balance sheet run off. They are no longer a buyer, messing up the price signal across the yield curve, which means that market rates now must prevail until they decide to play a more meaningful role. So I would say maybe one of the reasons that the U.S. has not had to be disciplined, along with most of the other Western countries that have a central bank and that have followed suit in a post-QE world, the reason they haven't been subject to fiscal discipline is because of a non-economical buyer that has distorted the price signal of that debt, and that non-economical buyer is not participating in the market right now. Your response, my friend.
That is the most cogent argument that I have heard for why this could be an issue, whereas it hasn't been an issue before. Mm-hmm. I think that is the only argument that anybody could make, and in my mind, it's still wrong. And I'll tell you why it's wrong.
I love you.
I'll tell you why it's wrong. But if there was an argument to make, that's it. Mm-hmm. That's the best one.
Okay. What's the argument against?
Here's why it's different. The UK did QE. They were subject to market discipline. Is the Prime Minister Liz Truss? No. Can't break the UK bond market. You get disciplined. What happened with the Eurozone debt crisis? They did QE. Were they allowed to get away without market discipline? No. The euro got trashed the moment it looked like Greece could go the wrong way, Italy could go the wrong way. This is all credit worthiness of the European Union, because all of these things are tied at the hip, or at least the Eurozone, because all these things are tied at the hip. Germany had to come out and basically pay for everyone because they had to live with the idea that if everybody's going to get a German credit rating, even if you're Greece or Italy, because you're inside of a single currency of debt issuance, then somebody's going to have to actually make good. And for Germany, it made all the sense in the world to make good because they're a big exporter, mainly elsewhere in the Eurozone. They need that system to hold. Germany's reluctance to pay other people's debts within the Eurozone, theater. They want to pay it because they need the system. So Otherwise, their economy is done. So when you look at other big, developed G10 countries that have done QE, they have not escaped market discipline. But the U.S. has. And you are right, absolutely, that what's mattered much, much more for where U.S. yields are is what the Fed is doing, what the economy is doing, the golden era of globalization, the structural decline in inflation, that pulling down yields. If there were a debt issue there, we would see there being some conflict between those forces and the forces of market discipline. We haven't seen it for a very simple reason. According to the Bank of International Settlements, 88% of global monetary transactions are settled in the US dollar because almost everything is done through SWIFT. And SWIFT, so even a country like if Brazil does a trade for crude oil with Argentina, it's still settled in US dollars because all the banks transact in SWIFT, and that's a US dollar-based system. Absolutely no one, including China, including the BRICS, including Russia, is in the constituency that they want an unstable dollar because then nobody can do business with anyone anywhere. There is no alternative. None. We've learned that the euro is not an alternative over the past decade and a half. We've learned that the Chinese yuan is not an alternative. They're trying to make it one. We'll see if they keep buying enough gold. That's a long-term story. But there is no alternative. And so there is no constituency to apply market discipline. Nobody is going to not lend to the U.S. because you need the system to hold in order for everybody to have an economy that works.
Well, real quick, what I'm saying, and it's what I find what happens whenever we get into like the credit worthiness discussion, it becomes a binary discussion, which is like, will the U.S. default on its obligations, or will we be downgraded? That's not what I'm saying, right? I'm playing nuance in between, which is an 800 credit score. That borrower, their credit score that goes down to 750. Did they default? No. But they're going to have a higher rate of interest on their loans. So what I'm saying is, in the absence of a non-economical price-insensitive buyer, and in a world where that we have QT going on, and the market is saying, and the Fed seems to be saying, play by the market rate, then the market is going to respond to this fiscal stimulus. And it doesn't mean that there's going to be this de-dollarization. It doesn't mean there's going to be a hyperinflationary loop, or that everybody's going to run away from the dollar. That's not my point. My point is that the market, for the first time in a very long while, in the absence of the globalization that started off this disinflation 40 years ago, in the absence of the non-economical buyer, you have the opposite of those two things right now. And for that reason, I believe we have structurally higher long-term rates until we decide to do something about that.
You're right. I agree with you. But that doesn't mean that people are going to shed bonds to buy gold because they're afraid of a U.S. credit issue. It's because we're going to have higher rates because of deglobalization and QT and demographic forces where labor is more scarce. I totally, completely agree with you that incremental changes matter, that higher rates are coming, that they're going to be much stickier than we've seen them in 40, 50 years. That's a core belief for me and a core reason why I'm skeptical of equities when they look like they're hopped up on rate cut bets. So, yes, 100% agree. I just don't think that it has anything to do with people shuffling out of bonds and into gold, and is therefore a catalyst for gold.
I can totally respect that nuance of that point, because the question implied dumping of treasuries. And the nuance here is that perhaps not dumping treasuries, but requiring a higher yield for incremental dollars into the treasury
Yes.
market is slightly
Yes.
different. And so I think that level of nuance is totally well placed, respected, and appreciated by good friend, and that's why they pay the big bucks. All right. Outside of gold, we're wrapping up. We've got about 5 minutes left here. We didn't necessarily dig into the FOMC minutes, and there have been tons and tons and tons of Fed squawk over the last couple of days. So I'll make this last one open-ended. What is either an instrument, a trade idea, or a topic that you think is top of mind that you and I haven't covered so far? Is there one?
Well, so for the FOMC minutes, I think you can summarize basically what came out of the FOMC minutes in a sentence. Listen to what Powell said at the beginning of last week. All the Fed squawk and the FOMC minutes, that's what it was. It was, hey, you think we're on autopilot? Stop it. Yes, we all want this cut. Yes, some of us think it was too big. Some of us thought it was just right. Most of us thought it was just right. La-di-da. But if you think we're on autopilot, and if you think that what we're saying is we don't care about inflation, we only care about jobs now, the way we only cared about inflation for the past 2.5, 3 years, no. I think that was the message. And that's what makes this CPI number so important. Because if they're not locked in, and they've been screaming at markets that they're not locked in. If they're not locked in, it'll be a real question. Because, by the way, it is not inherently bad if they hike or if they cut less. We saw this in January. Markets can go to fewer cuts in equities and keep going higher. It's got to make sense. So if we get CPI that's warmer, but it's for good growth reasons, I don't think the Fed's going to, we'll probably get fewer Fed cuts, but I don't think the markets need necessarily worry about that. But if they do, it's damning.
All right, let me ask you a question I've been dying to ask you. It's off topic, so I waited till the very end. We got 4 minutes, which I think is enough time. It's totally philosophical. I don't think it's highly tradable in the short term, but I cannot help myself but to think about these things and then want to ask people like you.
Sure.
It's the intersection between a lot of our conversations, right? Like this populism, it's the intersection of AI, protectionism, and then also sort of geopolitics.
Sure.
My question to you is, what happens in a world of infinitely scaling labor? So if we are on the precipice of sort of humanoid robots, we're on the precipice of generative AI, whether it's a couple years away or 5 to 10 years away. I don't know, but I think everyone would generally agree we're close. And then the cost of labor is sort of this one-time cost with this maintenance upkeep, right? For a piece of machinery or a piece of software that will do the task, and it's infinitely scalable up to your ability to fund cloud, energy, and data center, really. How does that change the fabric? Because I think on one side there are people that are worried about the lower birth rates across the world.
Yeah.
The fact that we're going to age and we have less labor to basically make up and replace it. And that China has, 1.5 billion people. We don't have as many people. They have a larger population, what that ends up meaning. But they're going through depopulation. But the flip side of this coin,
at the fastest rate we've seen historically anywhere.
But the flip side of this coin is that it's going to be met at some point in the next decade or so with sort of infinitely scalable labor. And I never really hear people talk about sort of those two things converging at the same time, depopulation, but an infinitely scalable labor class. What do you think that means just, for inflation or for growth? Like, do we see 6, 7, 8% GDP numbers coming out of the U.S.? And what do you think that means for China and their comparative advantage for the world? Just give me a pine on this sort of this idea, this theme, and bring us home.
Sure. So I would inject one word in your setup here, which is to say that we are not trending toward infinite labor. We are trending toward infinite grunt labor.
Okay, fair.
And that's a big difference. Because when we look at where the cost of grunt labor has gone historically, it's only gone down. With every technological innovation since we climbed out of the caves, the cost of grunt labor has gone down, and the cost of mental labor has gone up. The cost of human creativity has gone up. The premium on human creativity has gone up. So that's one thing. The second thing is, I want everybody here to think about what happens when you call any business. You just call them on the phone. What's the first thing you do when that automated voice comes on? You start mashing that zero. Representative, right? Because you don't want to talk to the machine. You want to talk to a person. That matters.
That's today.
It will be that forever and until the end of time, because we are a social animal, and what we want is human interaction. So yes, grunt labor, we're not that far away from infinite grunt labor. It's very convenient that we're not going the other way on this because of depopulation. We need infinite grunt labor. Not in the US, thankfully, but in Europe, in East Asia, the situation is catastrophic. I mean, Korea, China, all of Western Europe, almost. France is a little bit better off, but aging themselves into obsolescence, and nobody is aging themselves into obsolescence faster than China. So it's a catastrophe out there. If you thought in a sort of Malthusian way and said, we're going to run out of this resource and starve. But as ever, technology is on the verge of solving that issue. And all that means is the premium on creative human work, human creativity, human ingenuity. Because the machine can only do what we tell it to do. We still have to have all the ideas. And even AI, even generative AI, is still only trained on what we've already figured out.
Right. But at some point that shifts, right? And so I'm sort of talking, I'm not talking about where we are now.
Sure.
I'm talking about in that world where AI is training AI. And it seems to me we go through some periods, right? And then there's this period of...
And the adjustment's going to be painful, I think.
Yeah, major dislocation.
Very, very painful.
We always talk about unemployment like it's one flavor. You know, if you go back to your Econ 101 class, there are 3 different types of unemployment. You know, one of those types is structural unemployment. And so there's some part of me that goes, you know, I don't know how big or how long this period lasts, but there's a very clear issue on the horizon of structural employment where job skills don't match the available jobs in the economy.
Well, this is it.
Yeah. This is going to be a catalyst.
If you
and then there's another part of me that thinks, because I want you to answer this. There's another part of me that thinks, if I'm part of the CCP, right, and I know, and this is going to sound like I'm a psychopath, but if I'm in that mindset to think this way, that my comparative advantage was people, and now all of a sudden that labor advantage is going to get basically distributed or commoditized towards
running
the rest
away
of
on
the
you.
world. Well, then why would I want to keep... It's going to sound insane. Why would I want to keep my population so high at 1.5 billion? Wouldn't I want to implement policies at a structural level that will ease that burden and minimize the potential of an uprising into the future? What I'm saying is sort of nuanced.
I think if you're China, you don't have a choice.
What do you mean
your
by
population is falling apart all by itself because you destroyed your demographics over decades of a one-child policy.
I'm saying this as an elite. If I was a global,
I understand. I'm just saying you're careening.
China, it's everywhere.
I'm saying you're careening this way already. You don't need to have a policy. You're careening this way as it is. And you're careening this way in all of East Asia. You're careening this way in mostly Western and Central, but to some extent even Eastern Europe. I mean, the Russian demographic situation is atrocious.
Everywhere.
So except some pockets like the U.S. The other thing.
I don't know why you always say that. We are way below the population replacement rate. We're at 1.6.
We have a very different population pyramid. If you look at the cohorts coming behind, then
I agree with you. Our demographic pyramid doesn't look as bad as everyone else. But
not
it's
nearly.
Not like we are also running below population replacement.
Oh, no, sure. But our demographic story is much better than any other major economy by a country mile. But also, we have the incredibly advantageous situation that South America, and in particular Mexico, are right there. We have a free trade agreement in place, and we don't need labor from outside of our own hemisphere because we have a tremendously underdeveloped South American continent to pull from. Now, if you were to get to a place where creating economic value and economic growth for the first time in human history becomes decoupled from demographics, whereby we can have lower populations but more growth because grunt labor has become infinite because it's become automated, that just means more bigger economic growth downwind because more people can occupy their time with thinking about creative things which create more and more and more value. I think that's going to be helpful to fixing our fiscal issues, among other things. But the transition from point A to point B, as it always is in history, between eras like this, is going to be painful. And I only hope that we get the policy mix right, because when globalization was at its height, we screwed it up and we broke something because we didn't handle the popular discontent well for those small pockets that were net losers, because the overwhelming majority of the world were net winners. We did not handle those people that were net losers well, and now we've basically killed the golden goose for an era.
So true.
Hopefully we don't do that again.
Let me ask you this question, 10-second answer or less, because we got to get out of here. Every time we do this, 90 minutes
can't be helped.
All right. I'm going to make you president, okay?
Okay.
And I'm going to assume you have the right mix in the House and the Senate to get effective policy passed. And I tell you, I've got a time machine. Here's a report, Mr. President. The labor force participation rate, if we do nothing, is going to go from 62% down to 52% in the next 7.5 years. And that means real societal problems. You've got real societal problems on your hand. What do we do about this? What's the right policy mix? Is it UBI in your mind, or is it something else?
No.
What do you do?
No, I don't think it's UBI, but I do think that what you need to start doing is you need to start saying we are going to extract a tremendous amount of economic benefit from how you got to this point, just like we did from globalization. And we need now to start having the conversation that for every dollar of extra output that we get from this efficiency, 30 cents needs to go to backstopping the people that are displaced. We need to start.
Isn't that UBI? Or you would just have, you wouldn't have direct
not everybody's going to
payments.
be displaced. You don't need to pay everyone.
I got what you're saying.
You need to go and take care of the people that are not going to make the transition because they're too late in their career cycle, or they're in vulnerable industries, or whatever it is. You need to pay those people so that everybody else can get 70 cents on the dollar on what is going to be amazing for everyone eventually.
All right, man. From now on, I'm going to give you my last question. with 15 minutes to go that way, because these end up being sort of interesting thought experiments, and I could wind you up and listen to you for much longer. Unfortunately, we got to wrap here. If people want more from you on just social media, not the full list here, because we're
Sure.
a little bit past time, tell them where they can go to find more on your social.
I'm on the former Twitter machine at Ilya Spivak.
You can
And
follow me
everywhere on Tasty Live.
You can follow me at Victor Jones, the Owen Jones of Zero, because I like to be difficult. Every Wednesday, if you like what you hear here, the thought experiments or the expertise in Asia, please join us every Wednesday for a 90-minute discussion with the one, the only, the global head of macro here at Tasty, Ilya Spivak. I will see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Hit the like button on your way out. Thanks, guys. Peace.
We are back, and your eyes do not deceive you. That isn't Chris Vecchio that's lost his glasses and grown a bigger beard. We're on overtime here. Dylan is in from Milan. I'm in from San Francisco, and reporting from in studio, Tasty Live headquarters in Chicago, Mr. Thomas Westwater. Gentlemen, how goes it?
It's going,
Good
yeah.
to see you.
I'm not
Good
Chris.
to see you.
The Mets, I'm guessing that had something to do with Chris being out today.
Yeah, is this a Mets-related absence?
I'm sure it is.
My deep knowledge of sports ball is such that I am not qualified to answer that question.
All I know is I brought up the Dodgers, and I almost got thrown off this show.
I mean, that only strikes a nerve for those of us in San Francisco who love our city and know its deep culture of LASF rivalry.
Well,
if you were to ask me anything about baseball, actually, my eyes would glaze over immediately.
You just have a basic regional obligation to be anti-Los Angeles as a universal position.
I just very much wave the Northern California flag at all times.
Specifically Portola, I'm sure.
Oh yes, anything San Francisco city limits has forever captured my heart.
Of course, I can't blame you for that. So Thomas, Vecchio eased me into a bond position about 10% higher. Basically, you see where that last green bar is on this chart in front of us? Whatever that is, like maybe 10 days ago.
I do not see it.
Like right here. And I were talking. Oh, you can't see it anyway. You could, but visually, I'm sure mentally you can see it. Which is that the bond has been going down precipitously, in my opinion, for some number of days here, ever since that jobs number, all the things. Sosnov's talking about a little bounce. Ilya's ready to call his shorts off if the CPI doesn't cause an inflation panic. I haven't talked to you in a couple of weeks. You're sitting there in Chicago, the heart of all things bond. What's going on here, pal?
Yeah, I think, like you said, it's the jobs number kind of recalibrated those rate bets. The thing is now we have a pretty wide variance of estimates over the November rate hold or 25 or 50 basis cuts. So I think, there's some uncertainty there. You got the Bank of America ICE Move Index, the bond volatility, that's been pretty high. I think it's reflecting that sentiment that rate traders can't really nail down a specific scenario right now. So I was in the camp calling for a 25 basis point cut last month. They hit 50, kind of surprised me a bit. I think we could get another surprise where the market's not going to reach a broad consensus. And I think, the volatility is reflecting that. Is the CPI going to give us, of course, another data point is going to give us a little more insight or what we could believe is insight into what the Fed's doing. But I think at 120, it makes sense to take a stab at the long side. You got good technicals here. You got, the CPI numbers could definitely be a trigger point for a reversal. I like the trade. So I guess that's why I got to say. I usually, divert my bond opinions to Vecchio in any case. So not a huge trader on the bonds. Like you said, Chicago, I should probably be doing it a little bit more, but I like ZB at 120.
It certainly seems like an interesting and an auspicious spot. I don't know if we can see the charts now, but
I can see. Yeah, I don't know why Thomas can't see them. I can.
No,
see
I
him
can see it now.
earlier.
It came up. Yeah.
oh, okay, that's perfect. So if we look here, I mean, you can see this with the naked eye, right? Here was a level where we very pointedly had some resistance, and once we took that out, we were off to the races, and now we're back to basically backfill this gap, and we're sitting right at this level. So if we're going to hold anywhere, it's here. And we of course have CPI numbers tomorrow. Now, we know that lots of this steam coming out of it occurred in the wake of the Fed's policy announcement, right? Here's the Fed right there. So we reach a high right before the Fed comes out and actually sends this lower. Now, that seems to make sense to no one initially, because you go, well, hold on, 50 basis point cut. Why are yields going up, right? Because what this is the bond, which means the yield is inverse. So when this goes down, that's the long bond yield going up. Why is it going up when the Fed is cutting rates? And you see this response basically filter out across markets. Gold goes up after the Fed. The 10-year, 2-year yield curve spread steepens. You get all manner of sort of reflation dynamics. And that's largely because it seems like the markets essentially reckon, okay, they're cutting a lot now. The economy is generally fine. They're dumping stimulus on an economy that is not falling apart by any stretch of the imagination. This is going to mean inflation downwind somewhere, which means higher interest rates downwind somewhere, and rate cut expectations start to come in. You still have, looking at where we're sitting now, about a 79% chance that the two meetings left for this year go as scheduled, a 25 basis point cut at each. So markets are overwhelmingly tilted that way. Not fully, it's not fully baked in, but almost. Next year starts to get a little fuzzy. And so this is where the real question is. If CPI doesn't spook them, then this might hold.
I mean, I don't see how you don't become a bond buyer here. It'd be very simple. Maybe I'm missing something. And because I was a buyer, obviously at a higher prices, and was obviously wrong. But
right.
I still am more inclined to buy the bond. Full stop.
To your point, the only thing that's preventing me from being a buyer here is there is no green bar to suggest that this level is going to hold. And
fair enough.
And I don't know that it will until there is. Give me a green bar right here. I don't have to buy the absolute low. It's okay. I'd rather buy a little bit above the absolute low and pay for a little bit more confidence. Fair. And that's fine. I'm okay with that because we're in a long rate cut cycle. We got lots of these cuts coming, whether you want to quibble over a quarter point here or there. The Fed's cutting.
Sure.
That much we know. And November and December are basically on autopilot, it seems, at this point. It's next year that's the bogey. So I'm very comfortable getting long the bonds if the price action says, okay, it's go time. That's all I need.
So if CPI beats, does that change your view on if you're going to get long here?
it's the price action response that's the most critical for me, because if you look at the expectations, right, you're expected to come down to 2.3% on headline. That's the lowest since early 2021. And we just got data last week from the job side of things that wages are growing at 4%. That's the highest in 4 months. So you get inflation, it's not falling, yeah, okay, but it's growing at the slowest rate in almost 4 years. And you're looking at then wages that are growing at the fastest in 4 months and almost double the rate of inflation. So that's a very positive recipe for an economy that's mainly driven by consumption. That means that people's affordability numbers are very rapidly accelerating. The cost of living crisis is very rapidly unraveling. Not everywhere, not all at the same time, obviously, but very, very supportive. The issue is that most of that is outside of the purview of Fed influence. In August, it was mainly energy. This time, it'll probably be mainly energy again. And so when you look at the core, the thing where the Fed actually has agency, minus food, minus the price of energy, you are left with 3.2% now for a third consecutive month. We saw this movie before. When the core number was stalling in the first half of the year, the Fed went from expecting 3 cuts to expecting 1 cut to kind of loudly screaming in its own statements about, oh, there's been a lack of progress on inflation and blah, 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 blah. You get stalling at the core and the Fed's going to go, this thing isn't going at the speed that we want. And if that's what that is, if the markets essentially look at that and go 3 months, no movement in core is going to spook the Fed, it spooked them before, it might do it again, then it's a different story. Then you get maybe higher yields, then you get maybe a dilution of how much rate cut scope there is for next year. And you've seen some of the markets already adjusting for this. I mean, obviously, the very sort of straightforward version of where you see this is gold. Right? Like here was...
See what exactly?
Gold is coming down.
But no, but reflecting what exact sentiment? What sentiment is that reflecting to you?
That there are fewer rate cuts and that interest rates will be higher, and so an asset that
higher,
yields
longer,
nothing.
Slower cut. Basically, the higher, longer, cutting slower, and basically
Exactly.
CPI either confirms the September jobs report, or it contradicts it, and then that has to get mixed into the sauce. And your point is whether it confirms September or contradicts it is in fact less relevant, obviously, than how the market mixes whatever the data is into the sauce. And the mixing will happen, in your opinion, most visibly in gold and the bond.
Well, so there's gold, there's the bond, there's the dollar. All
Will
of
we
it
see it in equities?
That's the question. I think that's really the big if here.
Because you're saying for sure it'll mix into the bond, dollar, and gold.
Well, we've seen it, right?
Obviously,
so
right.
The dollar is screaming here. So here's sort of the benchmark version of the dollar here. This is the euro. I mean, obviously, the dollar is surging here, including today, by the way, into this data. The more yield-sensitive versions of the dollar, here's the yen. It's down. Dollar is screaming. Here's the Aussie. Dollar is screaming. Here's the Canadian dollar. Falling apart. Dollar is screaming. Here's the pound. Same thing. So the dollar is running roughshod over everything right now. And that, by the way, is helping me weather this equities thing being as stubborn as it is, because I have dollar longs on, I have a gold short on, and so the kind of upshift in yields by another name is.
But can we just game this out
am.
for fun? So let's say CPI comes in light, inflation fears are reduced, and now it comes back to my super glide, right? Now you're like, oh my goodness me, it's the ultimate super glide.
Oh, strong stock should go off.
Cuckoo bananas, right?
Yes.
Where does that leave bond, gold, dollar though?
Dollar comes in.
Dollar gets
bonds
weaker
go
on
higher.
super glide.
Dollar gets weaker.
Bond rallies
bonds
on super
go higher.
glide.
Gold rebounds.
Rallies. Gold what?
Yeah. Rebounds, yeah.
On super
gold
glide.
Rallies.
CPI's hot. Oh my God, the jobs number is all well and good, but the Fed's on the wrong side of inflation where they're going to get, they're wrapped around a tree on this one. They're cutting, blah, blah, blah.
Yeah. And then you get the kind of response that you've maybe just seen a preview of in China. And I only bring it up because it's a very similar narrative. Not that I would suggest that what's going on in China is going to influence U.S.
But it's just
markets.
a window into sentiment on perception.
It's just it's what happens when everybody gets all
the crowd
ginned up on stimulus hopes and then go, yeah, maybe it's not coming quite like that.
And they've done that before, right? We've seen that.
Yeah.
China.
Yeah.
So for 3 years, they were attempting to kind of cut a little here, cut a little there, a little bit cheaper credit here, a little cheaper credit there. They've also obfuscated some more of the numbers. They stopped reporting youth unemployment. They stopped reporting cross-border stocks volumes. They've done all kinds of attacked short sellers. They've done all kinds of things. None of it's worked. The reason it finally got everybody excited at the end of September was there was a whiff of maybe they're finally ready to create some demand by fiscal stimulus. And everybody went, oh, finally. It took them 3 years. They figured it out. An economy that's in deflation for 5 consecutive quarters doesn't have demand. Somebody needs to create demand. And if the private sector won't do it, especially in China where the public sector is a behemoth, they have to do it. And when there was a whiff of maybe they might, the markets just took off. And then nobody said anything or published any specifics. And some people went, I don't know how much. Maybe it'll be like 1.5% of GDP, but it needs to be like 4%. And the speculative bottom just fell out. It certainly didn't help the optics that when the rally was occurring, China was on a week-long holiday and everything was essentially offline. And as soon as they came back, all the market participants in China said, wait, our markets are where? Sell. And it's down by like 22%.
But are you suggesting you think there's room for a blowout sell-off tomorrow if you have a hot CPI? Is that where you're sort of conjuring?
Not a 22% sell-off.
No, I know. But
we're not talking. We're talking
S&P,
not the very comparatively illiquid.
Right, but a bad day in the stock market.
Yes. So I think it. So here's the really kind of interesting thing here. If you look at the weekly chart, we're trying to build some momentum this week finally, but look at what's happened in the preceding 4 weeks. Slower. Now, what's occurred here that this should be losing momentum? This is the Fed rate cut week. This is China stimulus in here. U.S. economic data has only gotten better. The service sector, we learned last week, is growing at the fastest rate in 19 months. The jobs report speaks for itself. It was incredible. And everybody that wants to whine endlessly about, these numbers don't mean anything, they're always revised down. Yeah, this report had upside revisions to both the August number and the July number, on top of beating expectations for September. So it was a blockbuster report. The unemployment rate fell unexpectedly, 4-month low, 3-month low. Wage growth, we said, unexpectedly, 4-month high. Like, the jobs market looked incredible in this report.
Wasn't that a lot? Anyway, that's a, yeah, I guess. But then there seems like there's some opportunity to sort of debate some of the underlying with that. But all the same, it was a beast.
Yeah, I mean, you look at the overall story and you go, okay, fine. This should be, I mean, markets should be screaming. The Fed is giving you all this stimulus. China is promising all this stimulus. The WTI Brent spread is under $4. It's been falling all year, so the markets clearly don't care about war risk. The data is getting better out of the US. Why are we not accelerating? Why are we slowing? That's sort of the main question for me. Why is this market not off to just a rocket ship higher? It all should be going right. And the only thing that, for me, is the fly in this ointment is what we just saw. Yields are going higher, which will load here eventually.
So you're saying equities are swimming against the tide pretty much?
It's weird for me that equities, with all of this positivity, are kind of limping along when a strong and stronger economy, more stimulus, and geopolitics that's more academic rather than actually disruptive to sort of global economics, that this is not giving us accelerating gains and is instead giving us decelerating gains, and by a lot. And the only thing that looks like might be the reason is higher yields. Is everybody's going, yeah, this is all well and good, but if the cost of money is higher downwind, we don't want to deploy risk.
So there's a lot of uncertainty. Do you place any of that about that, like the upcoming elections and even, possibly China stimulus? They could be possibly waiting until after the elections to like really set course on that. I mean, it makes sense, right? If you're going to announce a major fiscal package or commit to them, wouldn't the policymakers, the Politburo, I believe they're meeting in December for their annual meeting, wouldn't they want certainty around, like, if they're going after things that are more external shocks rather than the supply side within the country? I would assume they'd want to wait for the election to be over. So things like the VIX staying elevated above 20, some uncertainty, I think, is coming from that, from the bond market. So in my view, going higher, even with these headwinds, I think when you get the VIX coming back in, get some of this uncertainty coming out, I think that's when you rocket higher.
Maybe.
I mean, I just think it's a very interesting moment because you have the equities at or near all-time highs. You have a notable sell-off in gold bond and a notable rally in the dollar. Just those 4 items or 4 securities. And I feel like the CPI, they have to harmonize, because I feel like the stock market is saying, don't sweat the inflation. The economic strength is the beast. And if anything, I guess equities would say we win to inflation on asset inflation, right? Anyway, I just feel like that they're either and of the 2 categories, I feel like you're better positioned for a rally in the bond or a rally in gold and a sell-off in the dollar, I guess, more so than a big sell-off in the stock market, which my very moment of saying that might well mean that I'm wrong, because I can also argue against myself that a hot CPI would blast the S&P in the face. But it just seems like it's a moment where there's going to be an outsized move in the near term either way, which goes to your point, I guess, Thomas, which is that's where the volatility is coming from.
And I think the Fed kind of did itself a disservice. I wondered, did they leave themselves less wiggle room by going with the 50 rather than the 25 to start with?
I mean, for sure, the answer is obviously yes, other than the fact that maybe the Fed is not as worried as the market is. Like the Fed might be like, they're having a tantrum. We did our 50. We're going to do a quarter. We're going to keep doing quarters, and inflation isn't going to come back.
Yeah, I mean, one of the interesting things to kind of give context to all of this, we got minutes from the September Fed meeting earlier today. And to kind of illustrate what they were thinking as they did the 50 basis point cut. And they showed that there was very strong majority favoring that 50 basis point cut. It did show that some policy makers thought a 25 basis point one was fine. That would have been enough. And there was some arguing for that on the committee, but obviously those people got outvoted, even though you got the first dissent by a Fed governor, Michelle Bowman, in something like 2 decades. She wanted the smaller cut. Nobody, by the way, didn't want to cut. Everybody wanted to cut. The really interesting thing in those minutes is an overwhelmingly broad consensus that the Fed needs to be communicating to markets that they're not on a preset course and that everything is up to the data and interpretation. That essentially they are not committing to anything, that they're going to do this cut, and that it is really, really important to be talking to markets about, hey, don't get over your skis.
And that's what they've done well, right? Because if you look at others like the BOJ, where they pretty much had to come out and say, we won't upset markets, or we won't, do a policy move like that unless market conditions are correct. They said something along those lines. That's pretty much admitting that, they made a mistake in the timing, or at least they didn't telegraph it enough. I think you have to give the Fed credit on at least telegraphing their moves somewhat well, at least compared to other central banks.
Oh, without question. I mean, the RBA, for example, the Reserve Bank of Australia, is at this point in open warfare with their own bond market, where the bond market is yelling at them like, guys, you need to cut. And the RBA is saying, ha, 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 no. And the Aussie is selling off anyway, because the market is looking at it and going, no, you gotta cut. So it's a very good job overall that the Fed is doing. It's interesting. So last week, at the beginning of last week, Powell had that big speech, and he came out and said basically what we're talking about here, like, hey, don't get all hot out here. Nobody is going anywhere in a hurry. We don't need to cut quickly. We don't need to rush anywhere. We're not behind the curve on growth. This is fine. Our soft landing is very much intact. And then we got the hot data, right? That he said that before the hot data is very telling, because how much more do those comments then carry weight? He didn't see. So it wasn't a pivot. That was what they came out of, having just cut 50 basis points. And then the data ended up hot. The ISM, the NFP. So from the market's perspective, not surprising then really to go, okay, wait. So he set the ground now to say, we're not going to jump out the window. We still want a 2% inflation rate. Our risks, he said, are not one-sided. They're two-sided. It's not like we've gone from a singular focus on inflation the past several years to now a singular focus on employment. No. So that's, I think, the main risk here for markets is if they get a hot CPI number, does that throw the Fed off course for November and December? Probably not. But it does suggest that next year you might have less, and to the extent that what's happened in stocks at this point so far, that they're to any extent sluggish, is because of the rise in yields. You might get a further rise in those yields because honestly, everything else is going fine. Everything else is going the market's way. The economy is going the market's way. The Fed is going the market's way generally. The geopolitics are, at the very least, not showing immediate concern.